It's 7:07, and I'd like to call to session the meeting for the Town of Trumbull Pension Board for September 20th, 2022. And I would like to turn the meeting over to John Oliver and Lindsay to introduce our presenters for this evening.
Yeah, thanks, Patrick. So the first team we have on the call is Graywolf Capital. They're in Purchase, New York. And on the call, we have John Savitz and Eric Miller. John is the CEO of the firm. Prior to founding Graywolf, he was a partner at Goldman Sachs in the high yield department and had a long career there, and left and started his own firm in early 2002, maybe. We'll see how good I am remembering, something like that. And has since run Graywolf as a firm. We've invested with them in different clients for 7 years. They have a unique perspective, I think, on credit. I would say they're at times probably more contrarian than what a lot of people are thinking. And, you know, we like to have a lot of contrarian ideas in the portfolio at times. So I think this is a great one to hear about how they're viewing the credit space, how they've worked in terms of what we've invested in with them over the course, different types of distress vehicles, CLO funds, and also direct investments in certain co-investments with them across various clients, public pensions, and some endowments, and also some ultra high net worth clients. So kind of with that being said, I'll turn it over to John and Eric, and won't steal too much of their intro, but you know, the floor is yours, guys, and let us know if you need to share anything.
That's great. So thanks, John Oliver. Thank you, everybody, for having us. I'm Eric Miller, and I'm responsible for our business development team here at Graywolf Capital. And as Jo mentioned, John Savitz joins me on the right, is our CEO and CIO, as well as our founder of the fund. Is it possible for me to share the screen, or do you have to do that for me? I can share it. Okay, so I'm going to share the screen. And if I got this right, you should see Graywolf Capital. Is that working okay for you?
Mm-hmm.
Great. So here today, we're going to talk a little bit about our Graywolf Opportunities Fund 2. It's a special situation and distressed fund. We are targeting a $500 million raise, and our targeted net return here is 1.5 to 2 times plus a multiple on invested capital, and a 15 to 20% to the plus IRR. Again, that would be those would be targets in a more benign environment. If we get to a more significant distressed environment, which we think is possible, and John will talk to that, we think it could be meaningfully higher. We did have our first close for this fund late last week, where we reached out to initial investors who had reached out to us about starting a second fund, and we did ultimately raise just under $100 million to get us started, and we already are identifying a number of investments to start our investment process. To tell you a little bit about Graywolf, as Jo mentioned, we were founded in 2003. There's 32 employees. We're based here in Purchase, New York. We are an SEC registered alternative asset manager. We do have assets across the CLO space, distressed and special situations, as well as hard assets. And we have roughly $4 billion of assets under management. And as you can see on the slide, we do have a very experienced team, with some of our members having over 50, one of our members having over 50 years of experience, but many of our members, almost all of our members on the investment team, having over 20 years of experience in the investment space. We have 5 partners. Again, John Savitz, who's with me, founded it with Jim Gillespie, Bill Troy, Brett Bush, and Joe Marconi. So just to spend a minute here on, we talked a little bit about the experience of the team. This is a quick depiction of the high yield market back to the day that it was founded. We do have a team that's lived through many cycles. So I do think you will hear a lot of different stories about the distressed market, and many folks that have lived through the global financial crisis. I guess the good news of being around for quite some time, with many of us with 30 plus years of experience, we've seen a lot of different cycles. And so John started his career back at Goldman back in 1987, several weeks after, right before Black Monday. So some have blamed John specifically for Black Monday, but he was there during the time.
I knew it was coming, so
it's an old joke. And John ultimately rose up the ranks on the distress desk, and ultimately ran our the global public distress team at Goldman Sachs. I was there back at the time as well on the research side. And John made partner in 1998, left in 2002 to start Gray Wolf. And on that team as well was Jim Gillespie. Jim had worked on John's team. Jim then, was running proprietary distress bond investing. He also then, joined Gray Wolf. And then Adrian Weisberg. Adrian was at Goldman for a few years before joining Gray Wolf in 2005. And so this would be the team managing the assets in the distressed special situation fund, what we're calling, again, Gray Wolf Opportunities Fund 2. And again, a big part of what I talk about when I talk about Gray Wolf and why Gray Wolf is that we do have a deeply experienced team. We do have a strong track record. John will speak to that in a few minutes. We do have a differentiated portfolio. So we do look at, you'll see in our portfolio, it's a little bit different than what all the big players are trafficking in. We have all the big firm capabilities and experiences, but we are packaged in a more nimble fund and have the ability to look and construct smaller and more differentiated portfolios. So this is what this slide is trying to depict a bit of, like, all the capability that we do have, and our ability to really manage assets that are a bit different than what a lot of the others are trafficking in. So with that, let me, in the interest of time, pass to John, talk a bit about our track record and talking a little bit about what we're doing on the distress side.
Sure, thanks, Eric, and thanks everybody for taking the time. Please feel free to interrupt. Again, I'm not a huge book flipper, a page flipper, and things like that. I'll try to stick to the presentation. But if there's other things that people want to hear about, or if they don't want to hear about certain things, happy to kind of move us along. So as Eric mentioned, when we first got going back in 2002, 2003, we started in a hedge fund format. And so that was the format that was available, being kind of on the distress side of the equation. We originally wanted to start up on a drawdown structure, but we're told that we would not actually raise any money, and that was really a private equity type investment. And so we ended up in a hedge fund format, which basically was quarterly liquidity. And so our original, what we called our event-driven master fund, or special situations, not a particularly interesting name, at the end of the day, was our flagship fund that we launched and basically raised a bunch of money for. And we did, within it, we did a portion of distressed investing, but because distressed investing traditionally is longer than kind of a 3-month period, i.e. usually our holds were anywhere between 2 and 5 years, we found that we couldn't invest the entire portfolio because we would be mismatched from an asset liability standpoint. And so we did a bunch of other things like cap structure arb, interesting credits, special situations, things that had some liquidity. We hedged. We did a number of different things that we wouldn't necessarily be doing in a kind of drawdown vehicle. And that fund has done very well. It's been 11%, around an 11% yield life to date, and did fairly well. But coming into 19, basically we made the decision that we wanted to close that fund, not take any additional capital into that fund, basically monetize and basically look to basically maximize value in that fund, and really kind of go to the drawdown structure because we thought it was the more appropriate structure. We thought it aligned with all the things that we were doing, and also because it was now an acceptable structure and people were willing to give money to it. And so with that, we launched our Fund 1, which basically started investing in June of 2020. Has done fairly well, so off to a very good start. We still are in reinvestment and expect to see some more opportunities go forward, but basically a 16% IRR, multiple of invested capital of 1.1, and we're very pleased with where the portfolio currently stands. It's about 90% invested. And so as we were kind of approaching that number, a number of our investors in that fund reached out to us and said, okay, listen, there's a big opportunity set. You guys talked to us a little bit about what the opportunity is and why you think it might grow. We want to make sure that you actually have capital to pursue that opportunity set. And being 90% invested, you should be thinking about Fund 2. And so we were thinking about it, but that kind of gave us the nudge. And so the first foray into that is now this close for Fund 2, where basically it's only people who've been invested with us from Fund 1 who've now basically rolled as well into Fund 2. And we're going to reach out to kind of the general community after this close, which just took place. And as Eric mentioned, there were a couple of folks that basically couldn't quite get the documents, and we expect that we'll have a pretty another close pretty quickly thereafter for those folks who basically just couldn't meet the deadlines. So that's kind of where we are there. From a asset type, just to give you an idea, but basically, again, another point that Eric mentioned, we tend to be, we hope to be contrarian. We hope to be not kind of treading the same path that everybody else is treading. And generally that comes from a concept that, we've seen in the space, which is what we find is the larger players with a lot of capital sloshing around tend to basically look at the same situations and drive those price points to the point where they're basically taking a 20% risk, but getting a 10% return. Doesn't mean it's a bad investment. We just think it's a horrible way to invest money. It's not something we want to do. It's not something we want to put our own capital into. And so what we found is, because of where we've come from, because of our backgrounds, because of our training, we have all that big firm capability, but we're able to, because of the sizing of how we're looking at our funds, we're able to pursue opportunities that a lot of the bigger folks just wouldn't pursue, because even though they could probably see the same things we see, it just doesn't make a dent in kind of the portfolio that they're trying to invest. So they're trying to invest 100, 200 million in a crack. Whereas if we put a 20 to $50 million position on, it's really meaningful for the portfolio. It can help drive returns. And kind of that's why we like sizing it the way we do, and that's what we've done. And so in this slide in particular, what we tried to do was basically say, okay, here's kind of what the markets were invested in from 2008. We took 5-year increments. In 2008, in theory, was the last quote unquote distress cycle. And here's what Grey Wolf was invested. And so while there may be some names that overlap, and again, it's not that we won't do bigger names, we'll do them when the risk reward is basically skewed the way we think it is, and you're getting appropriately compensated for the risk you're taking. And as I mentioned, occasionally that happens, but more often than not, we've seen the bigger players kind of drive those numbers and those kind of opportunities to levels that we just don't think make any sense. What you'll find is the names that we're invested in, you might recognize a couple. And so, when you pick a year, 2018, Washington Mutual was a big name that everybody was invested in. We were invested in a different part of the capital structure. So while everybody was invested in seniors and kind of subordinates, we looked at the preferreds because we thought there was a unique aspect of the preferreds, and that played out quite well, but it was really more of a litigation play. Had shared the same name as Washington Mutual, but was a completely different investment than most people kind of were talking about. And even today, now you kind of fast forward into 22, the names that are getting kicked around in this trade, this chart changes a lot because the names change, and you're seeing a lot of stuff kind of flow across the transom. So right now it's, the names that are basically being bandied about: Bed Bath & Beyond, Bausch & Lomb, Cineworld. Those are names that are kind of currently in the marketplace, and we've looked at all of them. Right now, we look at those risk rewards, and a lot of them are trading and changing hands, and we basically think that, again, the risk reward isn't there. And so we've been investing in things that are, off the beaten track. We've been investing in litigation finance. We've been investing in the ship space, and we can talk a little bit about that on a hard asset side. We've done kind of smaller names that are just less well known and less well followed. And so that's where we think the opportunity set is. As I said, we're thrilled about where the portfolio for Fund 1 stands, and we're very excited about where we think we're going with Fund 2. Eric just quickly skipped over, and I'm trying to kind of move quickly because I recognize that you've got a lot of meetings and don't want to hold you late. Other parts of Grey Wolf, just so that you flesh it out. So we talked about event driven. We have a CLO business where we have $3 billion in. I think the reason that it's particularly interesting is that it's very synergistic. So we're looking from the top of the capital structure all the way to the bottom. We're looking all the way at new issues, all the way to kind of distressed. We have the same analysts working on all the names. And so an analyst basically can look at a new issue loan, basically say, boy, this is appropriate for the CLO, put it into our CLOs. Or they can basically say, you know what, we're going to start a file on this because this name is going to blow up in a year and a half, and we're going to want to look at it from the distress side of the equation. And so, we got that great institutional memory on that. From kind of our shipping business, this was another offshoot of kind of looking at the distress space. We were looking at distressed investing in shipping companies. Shipping is a unique space in that I don't think I've met an investor who hasn't somehow lost money in the space. And so whenever we start bringing it up, people kind of start throwing stuff at us. But at the end of the day, on the distress side, our analyst came to us and said, instead of looking at actual companies that are shipping companies, we should be looking at the hard asset. And what he had found was he found a unique part of the marketplace where they basically were smaller ships, 1,500 to 2,500 TEU type ships, 10 to 15 years old, owned by a disparate group of owners, basically being repossessed by the banks. Owners owned one or two. They didn't own a huge portfolio of them. You couldn't put 150 to 200 million at a crack to work like you can in the bigger ships, the VLCCs. And what his kind of process was, and one of the things that ultimately entered into our first fund, was he basically said, I can buy a ship, lease it out, simultaneously lease it out to companies like Maersk that are kind of investment grade, that you're not worried about your counterparty risk. And I can basically buy it for, you know, and I'll use an example of what we actually did in distress, buy it for $6 million, lease it out for 2 years for $6 million, effectively take out my cost basis over 2 years of lease, and then ultimately be left with a hard asset that's now 17 years old, where it was 15 when we bought it. It's now 17 years old. It has a life of another 8 years. Rates will either stay at these levels or maybe will be elevated and we can kind of release it. Or if not, we can basically scrap it for the metal, and the metal's basically worth another 50%. So we got an investment where we were looking at it from a downside and saying, I can basically make 1.5 times my money, and my upside is kind of multiples depending on what happens with lease rates. Really attractive, was something that we got invested in, started doing this in 17, basically started with 3 ships. We're now up to 22. We have a separate portfolio that does this, and a separate fund that just does this and just focuses on this. But from time to time, interesting things came up. The 2 ships that we bought that are currently sitting in our special opportunities funds were sister ships of things that we owned in our shipping business, but also basically came because there was a bankruptcy filing of a company, and basically 2 of the assets that they owned were ships. And so we went into that auction and bought it in an auction, bought it at very attractive prices.
Yeah, and then so we're gonna go here. To the upper
Okay,
right.
so now I've spoken a little bit about Grey Wolf and talked a little bit about who we are. Hopefully you get an understanding of it, and feel free again to ask any questions you want. But let me just talk quickly about the opportunity set, and then I'd like to just open it up and let you guys fire and ask the questions that you might want to know about. But basically, and again, a lot of this was when we launched Fund 1, we saw a massive opportunity in the space. And a lot of the things that we saw in Fund 1 are true of Fund 2. And in fact, I will freely admit, I thought there was a distress cycle coming with COVID. I thought that was going to tip over the markets. I was wrong. I thought the government wasn't going to support. And really what ended up happening was the government came in and injected a ton of liquidity again. They've been doing that since 2008. And I'm not just saying they being the US, it's global. So basically central banks have been injecting capital into the markets and allowing markets to run the excesses that have had and not be wrung out, because the fallback is the government will always put money and there will always be liquidity. I think the big thing that has changed, and again, I'm not going to say that we're definitely going into a distress cycle because I've been wrong in the past. And so I think we might be going into a distress cycle. We might be going into a benign environment. I think the luxury of it is in a benign environment, we're back to Fund 1. We've kind of demonstrated that we can make these unique investments and have a very good outcome kind of from the portfolio there. But to the extent that we're not back in a benign environment, I think there's a good reason for it. And I think that reason is really, I think it comes down to the Fed's raising rates right now. So we're back to something that I think we as investors who've been doing this for a long time understand. I freely admit we had no clue what COVID was going to do. I don't think anybody really knew what COVID was going to do, and still doesn't. You know, you've had supply chain disruptions. You've got a lot of different things. But when you get back to a more kind of things that drive the markets that we understand, and Fed tightening is something we do understand. This now reminds me a lot of what went on in '94 with regards to kind of what the Fed's doing. Is every other week the Fed was raising rates. And we're about to see what happens tomorrow on the back of a Fed meeting tomorrow. And I know there are different viewpoints, But it seems like the Fed has basically dedicated itself to fighting inflation and saying basically that's their number one goal, is to make sure that we don't have runaway inflation, even though we have fairly large inflation. But given that, I think the mandate of trying to manage that without throwing us into a recession is a fairly challenging one. And, the debates are, is it going to be a soft landing or a hard landing? But again, there's been massive excesses in the market that haven't been wrung out since '08. And I think it's lining up where those will come out. And so what are those excesses? You've seen credit growth kind of go off the charts. And so again, you can see just on this chart of where we were versus where the markets have doubled in size and then some on times of the credit size of the equation. I think at the same time, you saw credit quality deteriorate fairly significantly. And so again, that's measured in this instance is basically kind of the single Bs, single Bs, B minuses have grown fairly dramatically from 16% of the marketplace to 48% of the marketplace. I think not only have you seen a growth in kind of the sheer size of the credit market, it's also in the sheer number of names that have basically been issued. And so, you had something where you had 700 names. Now you've got 1.5 times that, 1,500 types of names in terms of the number of issuers. And so what that means is, again, from a manpower standpoint, if the manpower hasn't kept up with it, you just don't have the analysis that you used to have on those names. And so I think that's another thing that's going on. There's a massive lack of liquidity in the space right now. There's no liquidity in the markets. And so when bad news comes out, credits don't fall, 1 or 2 points. They're down 25 or 50 points as an opening trade because there is nobody supporting the markets. And then, I haven't even jumped onto private lending at this moment. But obviously, as the banks pulled away from the markets in '08 and individual funds came in to fill that void, and it became, quote unquote, a very hot market, with it basically became, deals that were getting done where 1 or 2 investors were doing a deal. And to the extent that they go bad, those investors walk away. Nobody knows the names, nobody's covering the names. And so that's created a whole nother environment. And I think one other point that basically, or 2 other points that basically drive to this, and then I'll kind of stop for a second, is there's been no there's no quote unquote distressed experience in the market, or very limited. So, and rightly so. If you haven't had distressed in kind of 12, 14 years, there's been no reason for kind of people to invest in that. So from a people standpoint, there are very few folks that are kind of in the distressed space that kind of have seen a bunch of different cycles. I mean, there haven't been that many cycles. And so right now, if you talk to somebody about, boy, what's your distress experience? A lot of it is either they don't have it or they've had it since 2008 was what they went through. And as somebody who unfortunately is old and having been through a lot of different cycles, I can tell you that all the cycles have been different. There are different things that drive them. And I think having that experience is a big competitive advantage. But it's just not just the investing side. You don't have the legal expertise in it, both from the lawyers that basically deal with it to the judges who have to adjudicate the bankruptcy filings. You don't have basically the workout professionals. You don't have the accountants, the restructuring folks. There's just a dearth of experience in the space, which I think could lead to a really attractive opportunity for those who can kind of navigate those waters. I think the last thing that I didn't hit on, which I think is kind of a fairly big thing, is the covenant light issues that are in the marketplace. So it used to be that companies had covenants in them way back when we used to do this. And so basically those covenants acted as brakes to basically make sure that a company couldn't destroy value. And so you put in covenants, if they got tripped, there was a timeout for the company. Basically the lenders would make sure that they were protected and basically that the company wasn't plowing all its money into the ground and they were going to be left with nothing. Those covenants went away. We thought it was a fairly major deal when we were talking about this in '08, where it was 15% of the market. And to us, that was dramatic. It's now 86% of the market. And so with that, basically, I think another part of the opportunity isn't going to be trading paper. I think it's going to be trading assets. And so it used to be we'd restructure a company and try and build around what the company was. I think there's going to be a lot of times where we look at companies now and say they're better off dead than alive, and let's strip the company and sell the assets. And so that's kind of where I'm going to pause at this point because I've rattled on for a long time. I don't know if there's questions people want to focus on anything in particular, or if hopefully we've done a decent job where people kind of understand what we're looking at. Sorry about that.
Would it be helpful to give maybe one example of an investment in Fund One that and how John and the investment team went through it?
Or Jo.
Yeah, I think that would be good to go through one of the investments so the board could get a flavor for, you know, what you guys looked at, what you saw, and then how you did it. Well, that's a good one to use. There you go. Everyone knows this one. So
Yeah, no, this was one that we came to as John Oliver talked about, where not only did we do it for the fund, we were hopeful that we could get a little bit more and do it as a co-investment as well. Unfortunately, the markets moved too quickly for us. And so while we were able to put it in the fund, we weren't able, even though we had the money to do it for a co-investment, we weren't able to get it on. And so we basically, as it ran away, we basically returned the money and said, doesn't make sense to basically invest people's money at a much higher level. So this is a name that, again, interesting that hopefully a lot of people know this name. I mean, I know I've been to a couple of the shows, you know, it's been talked about. It was Cirque du Soleil, and this was one of the first distressed investments and one of the two distressed investments that we did in Fund One before the markets kind of recovered. And Cirque was interesting in that as COVID hit, Cirque basically, you know, went from running a business to nobody was going to the shows. They couldn't go to the shows, and effectively they needed to stop. You know, they needed to file bankruptcy because they had no revenue coming. What was intriguing to us about it was that basically they could shut off and basically stop burning cash very quickly. And usually, kind of when you have companies, they've got an installed base, and unfortunately, they file bankruptcy not only to kind of restructure, but also because they've got to cut off the burn and the cash flow burn. And in Cirque's case, it was their capital structure that had caused them to have to file for bankruptcy, but they were able to kind of cut their expenses down to zero very quickly. And the reasons for that was they didn't own their space. Their space basically was built for them by the casinos out in Vegas, and it was basically used to generate foot traffic. And so they had a very good deal with regards to their space. And their workforce, unfortunately, basically was very specialized. And so there was really nowhere for their workforce to go. And so when they could downsize their workforce and bring it right back pretty quickly. And so as we looked at it, this is a business we thought, gee, it could sit in bankruptcy for a fairly long while they restructured. What was interesting about it was TPG was the owner of the business. They basically had bought it for $1.5 billion. They were going to grow it. It was an LBO. They put a bunch of debt on it. And then ultimately, as it filed, they tried to take it at a very low level by bidding through, you know, basically providing a dip and trying to take the company and put I think it was a 30-cent deal together where they would basically wipe out all the other debt and take the company. And again, it was through Canadian bankruptcy law. And so there are a lot of people that aren't familiar with Canada. We happen to know Canada quite well because we've been in that venue more often than not. We have a bunch of Canadians at the firm, and I always used to try and see if I could pay them in Canadian dollars and play the arbitrage, but they were smarter than that. So ultimately, but they knew the space. And once you're kind of in that space, you're part of a club. And so they know all the players and et cetera. And so while it was a big name, not a lot of people were doing this. And in fact, there were two of us that restructured this company and basically went in. And so when we saw what TPG was doing, there were a group of holders that basically wanted to have a counter proposal. We wanted to make sure that that counter proposal would be acceptable in the Canadian courts. And so we delayed a little bit as we kind of did a lot of work on whether or not we'd be successful. And once we concluded that our bid would carry the day in the Canadian courts, we started to invest in the company. And as I said, we invested, we bought the securities, we bought it at price levels that basically created the company at $750 million, which is half of what TPG paid for it. We basically knew that we could sit for a long while and basically not burn any cash. And then basically as kind of the markets presented themselves, we expected that we complete the restructuring and come out. And we executed on that plan. That was what took place. We did kind of see that there might be an opportunity. And so when we restructured, the equity, because it wasn't well followed, came out, I think, at $5. We reached out to a couple of our investors to say, hey, we think this is a really interesting co-invest. We went through kind of the logic. We got some money for it. Unfortunately, by the time we got that money, it was fairly limited liquidity, and I think the next trade out of the box was at 11. And so unfortunately at 11, while we still think it was interesting, we didn't think it was kind of the opportunity we had hoped for. And so while we had the ability to do it, we chose not to do it and we returned the capital. And so that's kind of Cirque du Soleil. We're still in it. We're still looking at it to this day, meaning, they started to launch their shows. They've actually come back all the way to where their revenue was pre-COVID. And they've got some really interesting growth opportunities. And so there's some significant upside to it. So we haven't sold out of it yet, but we actually sold out of the debt that we got back in the restructuring, and we're left with the equity piece. And so it's been a pretty good investment returner for us.
Jay, why don't we stop there? I don't know if there's questions from the board or we could add any additional details.
Does anyone else on the board have any questions for these guys? Thought I'd share something quick can everyone see this, or is it super small? Just to
No.
make you guys, that's big enough?
That's
Yeah, so this is just an interesting chart, kind of just it just happened to, when you said zombie companies, so I thought this was a good chart. This is the share of companies listed that have an interest coverage ratio for 10 years of less than 1, or 5 more consecutive years, actually. So it's probably a pretty bad sign, for meaning that, companies are basically using their debt to fund their existing, ongoing company, but not really making any money, right? So that's probably a pretty big issue as interest rates have moved up and they need to refinance. So I thought, I'm happy to share this with anyone after, but that's.
No, it's a good point. I mean, I think the answer is listen, the markets have been robust because whenever there's a problem, you can finance your way out of the problem. And that's what companies have been doing. And so the growth that everybody's seeing and kind of, there's this huge argument that we're not particularly levered. And so we're going to be okay. And the answer is, well, the earnings that you're seeing, I think, have been financed effectively in the marketplace. And to the extent that you're going to have a tough time raising more money as the Fed raises rates and as the markets become more discerning and more difficult, I think, unfortunately, you can't get rid of your debt, but your earnings go down. And when your earnings go down, it's companies that are 4 times levered that everybody's saying, oh, we're not that levered, all of a sudden turn into 8 and 10 times levered. And I think you're starting to begin to see that. And the first sign of that usually is in the convert market, which we've been following pretty closely, because the convert market usually is debt with the option. But as soon as basically the option gets out of the money, it becomes busted converts. And you're seeing a ton of converts now trading in the 40s and 50s that we think are worth kind of in the 15 to 20 area. So we've been basically eyeing it and basically have a number of names that are on our target list. Haven't quite hit the prices yet, but that's usually the first sign that we're seeing kind of a start of a more distressed environment.
Thanks, guys. If no one has anything else for the Gray Wolf team, I'll let them sign off. And obviously, thank you guys for the presentation. Parenthetically, I just had a Bloomberg chart come through that said global shipping is up 27% year to date, which two timely things coming through for you guys in the presentation, the zombie companies and the shipping. But yeah, thank you guys. If anyone has any questions, we can follow up with the Gray Wolf team, and I'll shoot them an email, or we can do it through the board, whatever the best approach is, and I'll make sure I get those questions to them. But thank you guys both.
Thank you very much for your time.
Appreciate it,
Thank
folks. Thank you.
Thank you.
Thank you.
So I guess if it's okay through the chair, I'll just introduce the next group of guys or gals to keep us on schedule.
Yeah,
so
I think as we just go through, just keep going through the
Okay.
schedule. All right, thanks,
Thank you,
John.
Chair. Yeah, so, we have, the next group is a little different, but, they're certainly susceptible to, big interest rate moves, but maybe in a little different way than when we're thinking about corporates and treasuries, right? So we have the team from Boyd. We've been investing with them for a bit of time with the fund here, in both their GSA fund, their state government fund, and now the diversified REIT. So, they're going to give us a bit of a flavor for what they're seeing in the marketplace. And then also parenthetically, Boyd as a firm, they're headquartered in Cleveland. They have offices kind of all over the place. I don't want to say all over, but in major cities, Chicago and some other cities. And they've been traditionally, I believe they've been business, Jack, you can correct me, I think since 1927, but it may be, around then. We've been investing with Boyd as a firm probably since the early 90s on the fixed income side. So we've known them, we've seen the firm grow. And, as they've seen a lack of opportunity maybe in the fixed income place, they have a lot of clients that were searching for the security and safety of kind of high quality or investment grade fixed income without a lot of risk. And so over the years, they've identified an opportunity first in government real estate, which they build out. And while they were embarking on that, they saw that there was opportunities in state real estate. And then beyond that, the newest fund, kind of mission critical investments with real estate and the government. So kind of with that being said, I'll turn it over to the Boyd team to give us a sense for, what they're seeing, how this market is impacting them, and, any updates they have. Does that sound good? Guys, is that okay for an intro? I don't want to, Brian and Jack, I don't want to, say anything off cue, but, that's probably what we'll be hearing from you guys tonight, I'm guessing.
Perfect. Okay. Well, Jo, thank you for the introduction. Can everyone hear me okay?
Mm-hmm.
Okay, perfect. Just very briefly, Jo did a good job. My name's Jack Hyland. My role with Boyd Watterson is in institutional marketing and distribution. We're accompanied here with Brian Orr. Brian is located in our Chicago office. He's a senior vice president, as well as portfolio manager of the GSA fund, of which you're investors in. First and foremost, thank you for your business. Your pension plan has roughly a total of roughly $4.5 million or so allocated across all three of our real estate funds. We've performed well. We've performed right within our targeted range of what we said we would do. Lindsay and Jo from Byrne, thank you for entrusting us. And again, Trumbull, thank you for your business. Boyd, we're an $18 billion investment manager headquartered in Cleveland, 6 offices across the country, as Jo said. We run numerous different real estate strategies. And I think one of the more interesting statistics about us is we're the largest landlord to the federal government by a factor of 2. And essentially what you'll hear across all 3 strategies, is to reacquaint you with Boyd Watterson. The common thread across the different strategies: we buy buildings where the government is the tenant. We'll lease it back to the government and they pay us a monthly fee for managing, overseeing the real estate. And really it's an income oriented strategy. We purchase properties that are income producing, and we generally meet our return targets predominantly through income alone. However, you get the added benefit of modest appreciation in our strategies. And with that, I'll turn it over to Brian Orr. Jo, do you need me to control the slides? I have it pulled up on my iPad, or I'm not sure if the board.
I believe Bill set it up so you could share. So
Okay, perfect.
probably better if you guys navigate your own slides than me figuring out which slide you're talking about.
Is everyone able to see?
Yes.
Okay, perfect. Well, Brian, I'll let you take it away.
Sure. Thanks, Jack. Good evening, everyone. Since everyone is familiar with the funds that Boyd offers, I thought I'd run through a couple quarterly comments here as of the end of the second quarter for the respective funds, and then open it up to Q&A and just give some high-level macro comments too on what we're seeing in the real estate market and how Boyd's positioned to kind of navigate these interesting times right now. But and then Jack will intervene as well and speak quickly to the partner statements that are relevant to you and your investments that you're currently in. But the GSA fund we'll start with here. We continue to grow and build out our systems to manage this fund. The GSA fund is currently about $6 billion in gross assets. We've continued to see high demand for this product, but also at annualized continue to meet our targeted returns in this fund of between 7 and 9%. We've seen about 7.5% annualized net return since inception of the fund here. But we continue to see opportunities in the federal government space even though the inflationary environment and interest rate environment we're in as well. The GSA fund has recently recast their credit facilities, extending maturities, as well as lowering our spread and our interest rates there by about 15 basis points back in April of this year. But we have about only 5% of our interest, or I should say of our liabilities right now that are not hedged or fixed. So we're in a good position to navigate this short-term rising interest rate environment here. The fund's leverage is still about just over 30%. And as you'll see in some later slides here, we still see a promising pipeline of acquisitions here as we move through the second half of the year. But the outlook is positive here. The fund, as you know, may or may not know, and the leases particularly with these federal tenants have inflationary protections. So as we're seeing this rising interest rate environment and these headlines of 8 to 9% increases in inflation year over year, we actually receive increases in our rent on the operating expense portion or the variable expense portion of the rents there. So we're insulated from a lot of these headline inflation adjustments that we're hearing and the increased risk here. We're also protected on the real estate tax basis as well with the GSA fund and the structure of their leases. So overall, I think coming out of the pandemic, in addition to the way we position the fund in this current economic environment, it really validates the strategy here of the GSA fund as we move forward here. And you'll see in later slides as well too, with that laddered lease portfolio that we have, as well as our laddered maturities on some of the liabilities that I spoke to, we really don't have a bullet year or anything more than 10% of the revenue of the fund rolling in the next 3 to 5 years either. So again, the long-term nature of the leases, the mission criticality and high renewal probabilities, again, we anticipate not a lot of interruption or volatility related to the income, as well as the valuations of these investments and the credit quality behind them. You want to move to next slide, Jack? So total returns for the GSA fund were 1.34% and 5.64% for the second quarter and trailing 12-month period respectively. And again, since inception, the total net return is about 7.5% of the fund. You'll see here on the right of the chart, I think it's important to call out here, we do benchmark against the Odyssey Index here, but what is important to call out is that the Odyssey Index has industrial, it contains multifamily assets. So they've really seen a lot of appreciation, which is driving those higher returns there that you saw. Lost you there for a second, Jack.
Sorry, I apologize. There we go.
There you go. In the comparison here in the chart on the right. But again, the product is really an income-driven product here, and you'll see at the net income returns below the comparison to the Odyssey Index and the income that they're providing over the past 2, 3, 5, and since inception years there, in particular through COVID as well. We did see folks telework from home, but the government does and did already have a teleworking policy in place, so not something new to them. And as well as in our diversification slides here later, you'll see that we're overweight Homeland Security, we're overweight Justice, and we're overweight Health and Human Services. Those are all agencies that it's really hard to work from home. You can't take the guns, the drugs, and the classified information and work from Starbucks or from your home office. So those folks have continued to be in the office. They continue to occupy the space and even have expanded in some instances because of the utilization rate that the government had in shrinking prior to the pandemic has really kind of been a net zero effect. They've now kept the same space and in some instances have looked to spread people out more in that space while keeping the same footprint in the buildings. And then touched on a little bit of the interest rate hedging that we have there. Quickly, I'll turn it over to Jack to speak about your position in the fund since 2019 and the performance to date.
Sure. So your initial capital commitment of $2 million was in January of 2019. You can see the fund has profited since roughly $500,000, 493,000. That equity currently stands at 2.1 million. Again, we've performed right in line with where we set our targeted range of 7.19% since inception of your original investment.
These are just a couple acquisition highlights we have through the second quarter of the year. We've acquired 4 properties, about $127 million through the second quarter. Right now, our pipeline has begun to fill up, as with real estate and the cycles throughout the year, and this being a little bit more of a challenging year. But we do have about $300 million right now under contract or under LOI for the GSA fund that we anticipate will close all of that, if not a little bit more, prior to the end of the year. So again, 4 properties, high occupancy in all of these properties, all mission critical, and you'll see the diversification is still consistent throughout the areas that we've acquired in throughout the year. Next slide. And then this is finally just a snapshot here of the fund and where we stand at the end of the second quarter. Again, $6 billion in gross assets. Our occupancy rate across the fund is actually 210 properties as it stands today. So again, we maintain a high occupancy rate of 95%. Our average lease term is about 6.5 years with those additional properties that we've added, and over 18.2 million square feet. I think one thing to call out on this slide, especially too, is our average cost of debt in this environment. Again, as I mentioned, the majority of our debt is fixed or hedged, and that average cost of debt at 3.69% is really going to, be a huge advantage for us in this rising interest rate environment to continue to meet the return demands of our investors in the fund. With that, I'll pause for any questions you may have about the GSA. The next couple of slides are diversification and areas you may be may be familiar with already, but can pause and answer any questions you may have about this particular fund.
Yeah, I'll ask one. This is Jim Meisner. Sorry, I don't have my picture on because I had an accident today and I'm kind of bandaged up. But have you had any defaults in the government fund historically? It seems like it's practically impossible for that to happen, but maybe you could give us an example of where it did happen and what you did.
No, we haven't had any defaults. The GSA fund, it's kind of not, it can't happen with the federal space. They can go into holdover and stay in the buildings and still operate if they haven't met their continuing needs. But one of the questions we have, I think, that ties closely to this is the government shutdown. And that occurred a couple years ago for about 30 days or so. And with the government shutdown, there is something that's called the Federal Buildings Fund, and they will continue to fund rent out of that over the, in this instance, the government shutdown. And if for some reason either the Federal Buildings Fund was completely depleted, which is a hard thing to do, we would have to go for a significant amount of period, or there weren't people in place to administer the funds, it completely shut down. When that resumes, all of that rent will be due in full and be paid with interest under the Prompt Payment Act of the federal government. So that is the closest thing to a default or a non-payment by the government of their leases that could happen. And when the shutdown did occur, it was only for 30 days and the government pays in arrears, so we didn't run into that situation. But if it did, and if it was for an over a long period of time, the government will repay that with an interest rate to their various landlords.
Thank you.
I have a quick question. When you had mentioned about it being a challenging year, was that specifically due to the rising interest rates and the uncertainty of where we're going as far as the direction of rates and how high they'll stay? Or is it availability of properties? What's the specific issue for this being a challenging year?
It's the latter. There's really been some price discovery between buyers and sellers, and where, given the rising interest rate environment, finding pipeline and finding available assets to fit our strategy, that has been the biggest challenge, where sellers and the brokers and the various individuals that they're encouraging to bring certain buildings to market, we feel that they're still putting pricing at a level that is reflective of interest rates at that 2 to 3%. That has obviously since risen. And as we're looking at assets to buy, we still have certain cap rate requirements that we need to buy at, and we feel that they should be at a different level, to be quite honest, in some of these assets based on market fundamentals and based on interest rates. So that's where the challenge is the disconnect between sellers and buyers right now that we maybe didn't see, and kind of the slower transaction volume that's taking place right now because of it.
Thank you.
Jack, we can jump ahead and go to the state fund then, if there aren't any more questions here on the GSA. I think it's might be slide 13. There you go. So similar story here. From the state government side, the state government agencies have seen a lot of direct aid from the federal government to the state and local governments, around, which is totaled around $685 billion, or 20% of state and local GDP. This will reduce a little bit as the pandemic lifts, and will support some future growth, but the balance sheets are in the strongest position they've been on some of these states. And again, I think it's important to reiterate and emphasize that we're not investing in all 50 states. We're not looking at all 50 states. Our targeted states are about 23 to 24 states that have investment grade. So that's where we're doing a lot of our investing, and those are our targeted markets. But additionally, the state rainy day funds are kind of at their highest levels in the past 20 years, which really helps insulate the states from any potential economic downturn with some of the funding that it did receive from the federal government. But similar story again, long-term leases in place with the fund that we have here, almost 8 years of term in the state space. And again, we're looking at critical service type tenants. This is going to be tied to health and human service and justice as well. Folks that have still stayed in the building and have really, we've been pretty good with our research group in positioning the state fund around these agencies as we look to acquire as well. Next slide's it, check. So the total returns for the fund, the state fund, were 1.4 and 7.51 for the second quarter and the trailing 12-month period, and 8.62 since inception. And inception of this fund was in March of 2018. Again, this compares to the a benchmark against the Odyssey index here, and you'll see the same story. As compared to the Odyssey index, we've outperformed, and specifically on the net income side, we've had some pretty nice income returns from the state government fund over the last couple of years and since inception, as it compares to the Odyssey index, which is really an index, commingled open-ended type funds as well.
As for the partner statement, your original commitment of $750,000 has grown to roughly $850,000. Again, you began in June of 2019. And again, we performed right within our bandwidth of 8 to 10% is our target for the state fund. Net return since inception's roughly 9.5%. So again, meeting return objectives.
This is the acquisition highlights for the state fund in the second quarter. We acquired five properties in the second quarter, 97% occupancy across the acquisitions, $266 million in purchase price, with the average initial cap rate of 5.7%. We did make a large acquisition in Brooklyn, New York in the first quarter as well, which is about $320 million. So we've acquired this year about $600 million through the second quarter in the state fund. which has led to, the queue for the state fund currently is about 650 million, but we are seeing more opportunity in the state fund. Just there aren't quite as many institutional owners in the state fund, or I'm sorry, institutional owners that we acquire from in the state fund. So we've seen some more opportunities there, just given the different ownership structures and ownership groups that currently own state leased buildings across the US. And this is the portfolio here of about 3 billion in gross assets currently for the state fund. We have about a 10 million square foot portfolio there with a 96% occupancy rate. And again, our average cost of debt here is about 3.1% of the fund, with a little bit higher leverage, which is why we've seen some pretty good returns and some results for our investors since the inception and over the last couple of years of this fund as well. So this gets into diversification, like we mentioned. Again, the larger allocation here to New York is the acquisition that we made in the first quarter this year. But similar to the GSA fund, we try to diversify across geography, across agencies as well. And again, we have a laddered maturity schedule with our leases, as well as our debt structure in this fund as well. With that, I'll pause for any questions on the state fund before we get into the diversified REIT.
Does anyone have any questions on the state fund before these guys jump in? I mean, the new fund is the one we just funded this with $2 million. So it'll be interesting to hear the progress and what the team at Boyd is doing. Sorry, did I unmute that? Yeah, okay, good.
Yeah, so the latest and greatest is the diversified government fund. And when we say diversified, this fund is, as we found with our other two funds, the GSA and state, as we would acquire these buildings, we were starting to find that there were assets located near or even next door that were occupied by government contractors, high credit quality tenants in the building, serving the missions within various federal and state governments that were located. And then we were also being funded by these federal and state agencies that were within the building. So we took this to our research team and found a really good opportunity, and the opportunity set to acquire a lot of assets that fit this profile that we found in the buildings next door. So as you'll see on this slide, there's about 3 times as many government contractor and grant employees as compared to federal employees, which is driving some of these, the growth in some of these buildings that we were seeing next to the existing footprint that we had in our existing funds. So in launching the diversified fund, we're seeing tenants like the Northrop Grumman's, Battelle Labs, Raytheon's, a lot of the government contractor names that you're familiar with that have high credit tenants in the building and have just a high credit quality that would be somewhat similar to these federal and state funds, but is more of a corporate credit, which is why we target 8 to 10% return in this particular fund. Next slide. So again, these are government supported missions, usually perform a variety of different property types. We do see a lot of lab functions, a lot of research, medical office type functions, data center functions that we've seen in these various assets that we've either acquired or have in our pipeline that we're currently looking at. We have to date this year, or since the inception of this fund, which was December of 2021, we've acquired 3 assets so far. We'll touch on those, I think, in the next slide or two, but it's been about $90 million and about 255,000 square feet over the first 9 months of this fund. Our second quarter returns for this fund were 2.3% net, and year to date for the diversified fund, we've returned 4.85% total net return. So we're going to continue to analyze that. We're looking at a pretty good return year in the first year out of the gates for the diversified fund as we continue to acquire here. But again, here's kind of our target markets and our investment process for the diversified fund. We're looking at areas where there's clusters of these different functions and different government contractor work. So we're looking at laboratories, life science areas, a lot of cybersecurity work in headquarters of kind of combatant command areas and bases. And a lot of the medical and grant research is done and funded to various public universities by the federal government as well. So it's been really kind of an interesting foray into this in some of the different opportunities that we've seen. A lot of the scientists, with these government contractors, the federal and state governments have caps on how much they can pay their employees. So this is really an area where I think there's a nice nexus to what the government entities are doing, where these contractors can obviously be paid higher. They're all scientists, they're lab workers. So it's really something that we feel is a stickiness to the government mission, either through funding or proximity of where they've established these areas to perform the contractor mission as well. Next slide. And they're going to have the same counter-cyclical growth. These two slides here just show kind of the expenditures by the federal government. Again, during recessionary times, during pandemic periods, we saw a lot of funding come into health and human services and a lot of the different areas here. And a lot of the research that was done during this time was funded as well into these contractor entities. We saw a lot of new leases be executed, and we've targeted various areas where buildings that we've bought in the federal space or the state space are renewing, and we're hopeful that our pipeline will come to fruition on some of these additional acquisitions that we'll make with these government contractors next door. This is just the build up to the return profile here, where we kind of expect to acquire these assets, and then with some leverage, and then breaking down to the interest cost, management fees, et cetera, and getting to the total expected net return for the diversified fund. So again, this slide is you've probably seen before in both our federal and state funds, but really we feel we can make an 8 to 10% total net return for our investors here. And then if you look to the right, related to what you would have to enter into on the risk return profile, we're kind of in line with private equity, which is more of a principal play, higher risk play, where we're meeting the returns here again through the long-term nature of these leases, the credit quality of these leases, but having more of that return driven by income here. And these just are a couple of the acquisitions that we've made. Idaho Falls was our first acquisition. This is a building occupied by Battelle Labs. Expires in 2028. And then on the right is Los Alamos. This is a renovated facility supporting the Los Alamos laboratory. And shortly after acquiring this, the tenant actually came to us and is interested in expansion possibilities, just given the lack of product in this space. And I think the obvious question here is, well, if there's lack of product in the space, is there risk of somebody coming along and building, something new or additional space? But with the costs rising around construction, the rates right now tied to construction loans, I feel like we're in a better position as the incumbent here with this type of tenant to expand for them, either through additional opportunities with land next door or other buildings in the area that we could acquire to facilitate the needs of the tenant.
Question for you. So on these properties, the amount of leverage you're talking about is pretty minimal, but do they also have mortgages on them, or what is the actual investment in these properties?
Yeah, so we don't put mortgages at the property level. All of the leverage that we're talking about is at the fund level for these various properties. So we don't, again, going back to the interest rate commentary, we aren't tying these to any sort of debt or mortgages that we would put at the individual asset level. We're buying these on a line or paying cash for these and then refinancing or paying them off with equity. So no individual mortgages for the property, and this is all fund level debt. I think it's important to note too, we can't ramp up our leverage in any of these. We kind of can't get out ahead of ourselves or over our skis. Our fund docs don't allow us to. The leverage point for these is 50% max. The GSA, we like to kind of be between 30 and 40, and the state fund kind of between 40 and 50, which will be typical of this. And you'll see that kind of here on the loan to value, kind of 40 to 50% leverage at the fund level, again, similar in the diversified REIT here. But the couple different nuances here. This is monthly inflows, but quarterly outflows. We do value our properties on a quarterly basis for this particular fund, similar to the GSA and state fund. But again, open-ended funds, a little bit different fee and investment structure here. But again, given that you guys have just been admitted and are in the fund, I think given some of the returns that we've seen to date and what the pipeline shows on this one, we've got a lot of opportunity ahead of us with this particular fund as well.
And do you now have a backlog of investors like you do in the other funds?
The queue for this particular fund is about 6 months right now, 3 to 6 months for this particular fund. So much shorter right now for this particular product.
Thank you.
Anyone have any other questions for Jack or Brian?
No?
Thank you guys for keeping us on schedule. Appreciate it.
Thanks very much.
Thank you, and thank you all for your time.
Thank you.
Thanks,
Thank
guys.
you.
Have a great night.
You as well.
So I thought we had Eve on here from Silver Point, although it said Natalie, so I'm not sure where. Oh, hey,
Yeah.
Eve.
Yeah,
Eve.
it's so
Well, we
weird.
have two Natalies on the call, but
Yeah, that's so weird. I don't know why. I'm on my screen, but anyway, I'm here, John.
yeah, great. So thank you all. So Silver Point, a firm in Greenwich, we have Eve on the call, who's a partner at Silver Point. Just to give you a little background, they're a credit manager in multiple types of credit. They've done special situations, distress. They were founded in 2002. I'm probably dating myself a little bit with the assets. They were probably, call it 17 or 18 billion at the start of the year. We've invested with Eve and her team with other portfolios for, I don't know, maybe 7 years now, something like that. So we know the firm very well. A great team. The founder was out of Goldman Sachs, was a partner there and took a team out and has been managing credit since 2002, if I have that right, Eve, I think. But if not, correct me. So I'll turn it over to you guys to speak a little bit about your firm, your expertise, and kind of, the opportunity set that you guys are seeing in the marketplace because of dislocations or what may be. Also, Eve, if there's anything that's proprietary, either let us know that you have to share and we could hop into an executive session. I know you were concerned about that, but if there isn't, we could keep it in this general session. I know that this particular session is probably Boya available. Okay. So I just didn't know if you have any proprietary slides on opportunities trading, what you were looking at, et cetera. But if you do, we could. I know Bill was gracious enough to set up a side session, but if you don't necessarily need to go into it, then that's fine as well.
Got it. I guess what we were looking at is, with the presentation, sometimes we put together sort of a short version versus a long version.
Yeah.
Because we don't want the press, they'll take our presentations and our slides and they put it into, whatever out in space. And so in here, so what I did, but this is just shared on the screen. So, I mean, that's fine.
Okay.
Right?
Yeah.
Okay. Yeah. So look,
unless you're giving us all your proprietary trades.
No, not at all. It just gives, no,
kidding.
it's just a handful of slides to
great.
guide the presentation, and everyone should absolutely feel free to stop me if I didn't go deep enough into something or a question around something that I had brought in. But I think my colleague Owen is on. Maybe that's the
Oh, hey, what's up, Owen?
And so he's gonna. Owen, can you?
Yeah. Hey, sorry about that. I'm on my laptop zoomed in, but then I have another Zoom under my name. Is it possible to share the screen from Owen Boyle, who's under the attendees? Okay, thank you.
Yeah, I'm sorry, John. our computer
No,
system
it's-
makes it very hard to share a presentation within our firm. Like we have Citrix, and so we have to log in from separate systems to be able to do it.
Yeah,
So-
that's a good thing. No, that's not a negative. That's a good thing. So we won't hold you at fault for that.
Okay.
Having good compliance, we won't hold you at fault for.
Okay, great. So look, as sort of John, you got everything accurate, but let me just spend a little bit on page 2, just to give a backdrop of sort of the firm and the platform and sort of Silver Point today. So got it right. We were founded in 2002. We're about 230 employees, always been based in Greenwich, Connecticut. Today, we manage about 20 billion of investable capital. So John, you were also pretty accurate. We have 17 billion of AUM, but our direct lending funds, which we call specialty credit, run on a targeted turn of leverage. So when you think about investable assets, it's about another 3 or 4 billion. So if you look at the platform today, we've actually been in all of these strategies since the launch of the fund. So our track records go back over 20 years. And again, as you had pointed out, the founders of the firm, Ed Muley and Bob O'Shea, had built and run these businesses while they were at Goldman. So they had run back in their Goldman days. And I think actually, let me just see if I put it in. No, so I'll spend it on this slide. So back in their Goldman days, they had run Goldman was very proprietary through the 90s. So they had run a global distress business, but they had also, using firm capital, they had set up a direct lending, middle market lending business. Their backgrounds, which are relevant. Ed was an investment banker for 7 years, worked in the office of the chairman. In 95, he came to the fixed income group, sort of within what was considered sort of special situations, distressed. His partner, Bob, had been hired in 90 to set up a bank loan trading business from scratch. So Goldman had never done a bank loan trade before he got there. So he built that business, went on to run global high yield and co-headed special situations distressed with Ed. So in all of these strategies, and as you think about the platform, they're very synergistic. The core theme is corporate credit. If you look at our flagship funds, invest in stressed and distressed securities throughout credit cycles. We manage about a little over 9 billion there. We then will raise distressed drawdown funds, really to look to time market dislocations. So we raised one back in 2019 as we thought you were late cycle, clearly not expecting a pandemic. However, we just thought spreads were tight. We still believed in credit cycles and we wanted to have dry powder ahead of that. And then the fund I'm going to spend time talking about today is our middle market lending fund that focuses on originating loans directly to companies, performing credit, and distributes income, quarterly to investors. But the reason it's worth just spending a minute on this, our background in really understanding companies and what happens to them when they get into difficulty, we think is a unique edge as we think about making a loan to a company at par, where what you're trying to do is think about what can go wrong and making sure you're putting your credit underwriting is good, you're putting a good structure in place to protect your capital, because you're really just trying to get an attractive coupon, as we say, generate attractive risk-adjusted return. So that's our platform. We've invested over 17 billion in middle market lending since 2002, across 380 investments. And since inception, we've delivered about a 13% net annualized return to our investors. So if you look at the next slide, a little bit about sort of the people in the process. So within our dedicated lending team, so we have about close to 80, this does include Ed and Bob. So we have about 78 investment professionals at the firm. Then we have about 132 people in the infrastructure. So relative to assets under management, we've always tried to be extremely well staffed, as the businesses we're involved in tend to be, it is about really digging deep, really understanding companies, really, focusing on areas of the market that have what we consider barriers to entry. So if you look at how the investment team is set up, we have a dedicated team just focused on The SCF stands for Specialty Credit Fund 3, so the middle market lending strategy. We have dedicated originators. We have our own dedicated deal captain due diligence, and then we have a dedicated asset management team. However, this team of professionals do get to leverage for the other area of the firm where we have dedicated industry-focused analysts, we have a dedicated trading desk and risk management. If we're doing a loan to, say, an auto supplier, the deal team on the lending side can absolutely tap into the industry-focused analysts to get a view on the industry sector trends, or consultants that can help them do additional due diligence. So there's great synergies of being part of the platform. And as we said, also a very deep infrastructure to support the team. The other, moving on to slide 4, the other thing, if you think about, and John, I'm happy for the committee. We can spend as much or as little time as you want on this. But another thing is we think about originating loans to companies throughout credit cycles. Silver Point as a firm has a dedicated markets committee where we have people who just study the markets, right? So they're looking right now and carefully analyzing, what do we think of inflation? What do we think of rates? What do we think of the Fed? What do we think are all the key risks to the market when you look at the war in the Ukraine, when you look at the risks that Europe has with such high commodity prices, the risks around China, the risks around, companies managing in a rising rate environment and how that impacts equity markets. And so as a firm, because of investing throughout cycles, this sort of view of where you are in the business and credit cycle helps inform your micro underwriting of companies, the industry they're in, the key risks to the market. So while our lending business is not a markets business, right? It's a private credit origination business. Having a view of where you are in the business and credit cycle, having a view of companies and industries and sector risks as part of your underwriting, we think is very important. And all of our strategies benefit from our sort of top-down view of what do we think of the markets, where do we think we are in a business and credit cycle, what do we think of rates, and what do we think of the risk of a recession, and how do we think that's going to impact companies. So we have very much a bottoms-up fundamental micro process. We have a dedicated investment committee for this fund, but then they get the benefit of incorporating the top-down into the underwriting on the companies. As we think about, and for the next slide, as we think about the lending business, when we look at it, we think you need to do 5 things well to do this business well. So a differentiator as part of our lending business dating back to the 90s, as I had mentioned, Ed and Bob, they had run the leveraged finance desks at big banks, as well as invested proprietary capital. And so they saw how the industry and finance companies were set up to finance companies. And what they saw was that high yield markets, leveraged credit markets, asset-based lenders, even a lot of the middle market lenders that have been sort of created post the global financial crisis to target sponsor-backed LBOs, they were set up to originate loans into what we call a box. And they are not necessarily relying on independent fundamental credit work. And they're relying on sort of a public market valuation, or right within the high yield market, it's running an auction for financing through the broadly syndicated market. And what that ultimately means for the borrower is that the borrower gets very, very efficient pricing because they're running an auction. And what we've found is that there are a lot of very good companies that just either don't want to run an auction, or they are not set up to run an auction, or they might have a level of complexity to their business, or they might be in a misunderstood industry where your credit expertise and your fundamental credit underwriting allow you to go after lending opportunities that are just less competitive. And the reason why that is attractive is because what that means is you can you can have higher pricing, right? So you can price it at a premium to an auction market. But what you also, even more, just as important, and maybe more importantly, is you can get a very good structure and document in place. Because our strategy is a senior secured lending strategy. And we are always going in there, as we talked about from the beginning, thinking about what can go wrong, thinking about protecting the downside. Because this, is an income strategy. And what you're trying to do is what we think is generating very good absolute, but also risk adjusted returns. So to be able to do that, you need to be able to have differentiated sourcing. So we have dedicated sourcers. We also have a broad platform where we just talk to a different relationship. We're not just calling on the sponsor. We're going out, we're talking to the advisory community. We can have different conversations with the broker-dealer community, specialty brokers, lawyers, accountants, people who have deals and opportunities where, again, they're not looking to run an auction for the process. And it could be that they don't want to, or it could be that they want someone and they value the credit underwriting expertise. Then we'd say you need to really be able to underwrite the credit, right? Form your own view of what you think the company is worth. We think we leverage our expertise of having, in a completely separate part of our business, manage distressed assets. So we try to use that to think about what's the documentation and the covenants we need up front. Then we think you need to be able to properly manage these loans. You need to be able to identify through your underwriting process, what are the key business risks? What are the things to be, paying attention to? When should you be being active and trying to manage an asset? If you do go into, we do think there's a risk that you're going into a recession next year. So we think that skill of being able to monitor the portfolio, identify weaknesses at companies early on, but then asset management. So if a company does breach a covenant, how do you deal with it? The ability to re-underwrite it, to see if this is an issue and your covenant, this is an opportunity to sort of, we call de-risk the loan, or is this an opportunity where you need to have a conversation with the borrower of putting in additional capital, or is the pricing still appropriate given the risk of the loan? So when we look at it, it is a terrific business where, as you can see, you can generate very high absolute and risk-adjusted returns across credit cycles. However, we would tell you, you need to have a specialization of focus and the ability to do all of these things, or the business is not a great business. If you look at, and so as you can see, we have significantly built this out over time and have managed, very large portfolios through multiple credit cycles. As you look at, and if you go to page 6, as you look at the business and different themes that would go into the portfolio, the core focus is these, what we call specialty lending. Again, it's because we call it specialty because we're not going after these competitive LBO backed financings. We like to go after loans where there's reduced competition, whether there's a sponsor or non-sponsor involved. And then there will be opportunities, which we'll call capital solutions, where there could be a transaction where generally there's a level of complexity, but there's also a need for speed and certainty of execution. And those we call capital solutions. Really, the difference between those two is you tend to get slightly higher coupons. You also tend to get greater upfront, OID, so fees, and then you can usually get very good call protection on these loans because you're providing a service where there's complexity and speed. We also will have some loans that are just collateralized by hard assets. This is not a real estate strategy where we're looking at cap rates, and what this strategy is it typically tends to be smaller borrowers where they're looking at loan sizes of like 20 to 100 million. They can't go and access traditional sources of mortgage financings. They tend to be buying these assets at a real discount, and they're looking for a transitional sort of bridge financing. Tends to be very, what we call loan to value, very low LTVs, and they're actually using the loan to improve the properties. So very good business. Here, we've probably originated within asset-based lending, I want to say about 700 million. So again, it's niche-y. It's, can be probably like 10 to 15% of the portfolio, but tends to be very low risk, and has generally generated about a 15% IRR on those assets. So we like it. And then the other thing we can do, but it's, you never know what's going to happen, is what I call the baby with the bathwater. So there are times when you see pockets of volatility within the broadly syndicated markets where, given we sit next to, a large credit trading business, in times of volatility. So if you think about March of 2020, what we were able to do is we were able to basically what we call pivot or toggle, where we were buying very safe, low loan to value performing credits at a material discount to par. Could this be 10% of the portfolio? It could be, but it's hard to know if you're going to hit those levels and pockets of volatility within sort of the investment period. And so that's another thing that, that we do that can be a differentiator within the fund. But the core is middle market loan origination into less competitive opportunities where we're really leveraging our ability to source through our platform because our differentiated relationships, our ability to do core credit underwriting, upfront structuring and documentation around key business risks, and then managing the assets throughout cycles. So that's the core of the strategy. The other thing I would end on is when you look at the portfolios. So we're in the market with Fund 3. When you look at the portfolios, if you look at slide 7, when we look at sort of risk, right? These are the different characteristics. So you can see, primarily first lien. So this means $1, senior secured, where there is a second lien in the funds. We own the first as well. So it isn't like there is debt ahead of us that would be negotiating something that we wouldn't be involved if there ever was a covenant breach. And then when you look at what we call the loan to value, so if you think about the enterprise value of a company, so if it's worth $100, we're lending $50. So you have a very nice cushion on value. And again, that's why covenants are important. And then when you look at sort of the leverage that the average borrower has, that is, as provided by our loan, it's at about 4 times. And if you look at, say, the broadly syndicated market, you look at other leverages dramatically higher. So actual company leverage is low, primarily first lien, and very nice cushion on value at where you're lending to. The dynamic that has really changed, that has made also this asset class pretty interesting, if you think about what's going on in the markets today, to get into a little bit about the market opportunity. You have, I don't know if people have been following, but the investment banks committed to about 80 billion of middle market, of broadly syndicated loans that they have been unable to. So they've committed to do the financing, they've committed to the borrowers, and they have about 80 billion what's considered hung on their balance sheets that they have not been able to syndicate into the loan market. So since you had a run up as the Fed has been raising rates, you would think the loan asset class would have been a little more immune because it's a floating rate product. However, everyone is associating rising rates with recession, and people are just worried about credit. And so you've seen an outflow of capital within the leveraged credit markets and high yield. And so the banks that have committed to this financing are having a hard time moving the capital. So what it means is they're not committing to new financings. Then additionally, so that's good. So there's just less access to capital. So that's a good dynamic. For us, you've also seen spreads in this broadly syndicated market move higher. And we're always pricing at a premium to what you can buy in the liquid market. So it's allowed us to increase our pricing. And then additionally, our loans are floating rate, and they're LIBOR based or SOFR based now. And SOFR was at 0. We generally, in our funds, were getting, 1 to 1.5, what's considered floors. So the borrower had to pay us a minimum of 1 to 1.5 of LIBOR or SOFR. Now, LIBOR, the 1-year LIBOR swap is at 4. So if you even think about over, right? So LIBOR has moved up dramatically. And if you think about then your spreads have gone up. So average coupons now should probably be a little over 7%. Your now LIBOR has gone, if you look at a 5-year swap on LIBOR, it's about 337. So if you think about you're getting the 337, now you're getting a higher coupon. Your LTVs are not going up, right? You're still lending at a similar risk level. Multiples on companies have come down. So, right, where you're financing through has come in, but you're able to charge more, and your base rates have gone up, and there's reduced access to capital. So the market dynamic right now for senior secured middle market lending, we think is really attractive, given the dynamics that are going on in the market. As we say, there's opportunity throughout cycles, but as a firm that deeply studies business and credit cycles, the risk-adjusted return in lending has gotten very good. So with that, I know I've gone on for a while. I'll take a break and answer any questions, John Oliver, that you have.
Yeah, I have a question, but I'll turn over to the board members first to see if they have any questions for you all.
Yeah, it's Jim Meisner. Hi, Eve. Sorry, I don't have my
A
picture up
friendly
there.
face, a friendly
I've got
face.
a
How are you?
heavily
That's a
bandaged
coincidence.
eye right now. That's kind of ugly to look at. So,
Hmm.
so could you just speak to the sizes of the funds 1 and 2 and the target size fund 3 and what the fundraising is looking like for fund 3?
Sure. So fund, if you look at, the specialty credit 03 vintage was about 9 billion. Fund 1, we had intentionally raised and about 550 million. As we were looking, we thought we were sort of a little late cycle. And looking back, having capital, Jim, as you know, in this strategy is really important in sort of looking at opportunities, winning deals. We had in total about 750 million of equity capital between the dedicated fund and an incremental fund from we have a large institutional investor base from one of our investors. And then fund 2 is a little over 2 billion and it's about 82% deployed. And then fund 3, we're looking to raise 4.
So fund 2 is basically getting near the end of calling capital. And what do you think would be the schedule for starting to call capital in fund 3?
We're on target. We're going to close on about $1 billion at the end of October. We think it'll start investing as soon as we do the fund close. And we would estimate that we think it should be, it's hard to know. You get a real dislocation in the market and a real vacuum of capital. Maybe it gets invested in 18 months, but we think it'll probably be 24 months. And you'll get a recycle. The investment period is 3 years. And we distribute the income and profit quarterly, but we recycle principal within the investment period. And Jim, as you know, in this strategy, we try to get call protection, but the average, and they tend to be 4 to 5 year duration loans, but we tend to get refinanced out within 2 to 2.5 years. So we actually think you get, fund 1 has had like a 1.5 multiple of money. For a lending strategy, that's quite high, but it's because of the refinancing that we have within it. And the way that we thought about the fund size for fund 3, when we looked at fund 2, we run the portfolio very diversified, right? In credit, you need to run very diversified. And position size is sort of 1 to 2.5%. And if we look at just the deals we sourced, underwrote, originated, we could have deployed about another close to 2 billion on just the deals we did in fund, across fund 1 and 2. So that's how we came up with the target fund size for fund 3. But I got to tell you, since we launched the fundraising, the market opportunity the access to capital has just gone down. So it's actually gotten very interesting.
Great, thank you.
Does anyone have any more questions for the Silver Point team? Jim kind of covered my question, so that works out well. Hey, Eve and Owen, thank you guys very much for the presentation. We really appreciate it, and great to hear from you guys. So thank you for your time tonight.
It's our pleasure. We appreciate the opportunity.
Thank you.
All right, everyone, be well.
Thank you.
So I think we should have, is the Golub team on? Was that John? Okay.
Yes, we are.
Hey guys, how are you? What's up, John? How are you?
We're doing great. Thanks for making the time to have us, everyone.
Yeah, so let me just introduce Golub. We'll see if I've been close enough on, the other firms. But Golub is in a similar space that we heard from in terms of lending, middle market. And so it'll be just interesting to hear a different point of view. Golub was founded, I believe, in mid-90s, say 1994. As a firm, we've invested with them, I don't know, maybe 7 to 10 years now across various clients that are both public funds and some E&Fs. And so, when really we think about the marketplace and, maybe a pretty troubled marketplace, I wanted the board to hear from, some income strategies. So especially ones that, we feel are like pretty high in the capital structure with a lot of security to them. So I'll turn it over to Golub and their team to go through the presentation. I mean, their offices are in New York, Chicago, London, maybe LA, or is it San Francisco? One of the two. So that's where, pretty broad headquarters across markets. And I'll turn it over to the team to talk about, the work they've done and how they think about the marketplace and the current situation. So thank you guys for being on the call.
Thank you so much. And just before I move forward,
that's on the screen.
yeah, I was trying to help you out there, John.
Yeah. I think I was right. San Francisco, not LA, but
I'll give you a 95%.
Yeah. Thanks, guys.
Great. So everyone, before going forward, I know we're past our start time. Is there any adjustment? How much time you want us to spend? I think we had 30 minutes. Do you need us to shorten it up at all?
We started about 7 to 10 minutes late, so I think it's okay as long as
I
it's
think
okay.
we could just stay on schedule for a half an hour.
Okay,
Yeah.
great. I just want to be respectful of your time. I know it's a Tuesday night. So first, just thank you. It's always an honor to be included in these opportunities to be a manager for a pension plan. I've been covering pension plans since 2010, and I know the retirement security that you all seek to provide to your pensioners is paramount and vital to their happiness. So thank you very much for this opportunity, and thank you to John Oliver and team at Byrne for including us. So my name is Peter Kenny, and I am Associate Director on the Investor Partners Group here at Golub. And my focus is to develop relationships with the consulting community and with the investor community and providing suitable investments for them and for their plans. With me is John Simmons, who's a 13-year veteran at Golub and who is the head of our corporate development practice, essentially the group that looks to help create the products and the vehicles that our investors will invest in to ensure that we are representing what we think are opportunities in the market. And we're here to discuss the Golub Business Development Corporation Fund 4, or GBDC 4. And in speaking with John Oliver and Madison before the call and preparing our remarks and our materials, it was important for John and I to hear, where is the town of Trumbull, and understanding that you all have a funded status in that mid 30% range. There is a need for what may be considered, competing factors, but both income and downside protection. We do feel strongly that GBDC4 and Golub Capital are in a unique position to provide those two attributes in this investment solution. The fund that we're discussing today has a target return of 10.5% to 13.5%. And what's interesting about this solution is that 10 to 12% of that will come from income generation. And again, with markets that can be volatile, having that consistent return we think is vital for you meeting your needs.
It's also going to come from a well-diversified pool of borrowers, over 200 different borrowers. So that helps to mitigate risk from any one borrower that may have stress within a portfolio. And also it's going to come from non-cyclical sectors. So again, thinking about everything that you're all looking for, we focus on borrowers that operate in sectors that are not as susceptible to the economic volatility that other borrowers may be. And again, we want to provide a diversified portfolio. In trying to think about how to encapsulate who we are for you all, Golub Capital is a distinctive and reliable firm. And there's 4 points I just wanted to highlight before going into the presentation. The first point is our scale and our pedigree. Managing almost $60 billion in assets and having done this for almost 30 years sets us apart from a lot of our competition. We've seen many economic cycles, been through periods of volatility and defaults, and we have a sense of what's going on in this space, and we've helped really evolve this space ourselves through being an innovative provider of finance to private equity firms. And that really is what we do. Our goal is to be the finance provider to private equity firms to help them win the acquisitions they're looking to make. And by looking at over 25,000 different transactions in over 30 years, we have quite a bit of a log and of a database to pull from to understand trends in the market and how to, what we think, make optimal lending facilities to borrowers. We also have invested over $100 million in our business, in our data. We want to make sure that all the data we've accumulated can seamlessly flow from the originators that source the deals, the underwriters that underwrite and structure them, through to the portfolio management team, and to work out should those situations arise. The second factor would be a higher quality. I think a question that we typically get, or that you may ask anybody that wears a private debt hat, is where do you operate in the space? Historically, I think people focus on lower core or upper middle market. Those 3 buckets defining what level of company you're lending to in terms of EBITDA, how much they have in earnings, between 10 and 100 million. While that's important to highlight and to operate within that construct, we simply focus on higher quality names. We do look at lower and core middle market names to begin with, but we want to make sure that regardless of the size of the business, it's a healthy business, and that we will be able to provide outsized returns to our investors by ensuring that we get the return right. And by focusing on lower and core middle market names, we're able to grow with these businesses. And that helps to provide a bit of a mitigant to risk, in that lending to a company you already know is much more of a better risk-adjusted return than lending to a company that you don't know, or is maybe only one transaction in. So when you look at our profile of who we lend to, the average EBITDA or earnings of the companies we lend to is about $56 million, right in the middle of the core space. But about almost 80% of our originations are to lower and core middle market firms. So that way we and you can benefit from what could be 5, 6, or 7 different transactions to a company where we are receiving monthly financial statements, know the sponsor, and know the management team. The third distinctive factor, I'd say, is our product offering. We've been pioneers in terms of how we provide financing to middle market companies and the PE firms. We look at things like unitranche facilities, essentially an industry term for providing both first lien and second lien financing or positions to a single company. So we actually can hold anywhere from 25 million to 700 million by ourselves. And this helps not only the PE firms, but also the companies know that they can come to us repeatedly and they don't need to worry about developing trust and rapport with a new lender midway through their growth cycle. And then the fourth distinctive factor, I'd say, is our industry expertise. Having done this for a long period of time, there are a few sectors that we have naturally migrated towards. And again, we think that this helps separate us from the pack in that software, healthcare, financial services, and consumer, the third bullet point on the bottom of the page, are areas where we excel. We feel strongly that we have sourced more transactions in these 4 sectors than many of the PE firms that we work with. So to give you an example, in software alone, over the last 13 years, we've done over 650 transactions, almost $60 billion in capital originated. So whether you're talking to Thoma Bravo or TA Associates or any other leader in the software private equity space, we have done more deals than they have, and they know that they don't need to educate us. We can move quickly, and we can also share with them best practices in terms of these sectors and help them win the business. So these 4 factors come in together nicely. It helps us move quickly with our decision-making process. It helps us mitigate risk We lend about 50% of the deals that we originate are to companies that we already know. So again, that helps provide protection to our investors. And then it also helps us have lower amount of credit losses, and by extension, lower costs of leverage in our funds. And then that helps us provide higher returns without having to take extra credit risk. So that's a bit of an executive summary for who we are. And if you look at the next page, I think what's important here, and if you can't see this, please let me know. I'll try my best to increase it. I think really for you all, it's the best proof statement is this page. Looking from left to right, you can see our calendar year returns, but inception to date net IRR on the far right helps to smooth out volatility from any one year. And you can see that across all of our vintages of strategies, we've come to about a 10% return net on a net basis. And all these funds, you know, there's some different names you'll see on the far left side of the page, but really we are simply a middle market direct lender. So while the funds may be different, the nuances really are around leverage or around liquidity in the funds, but the core investment engine is singular at our firm. And again, this helps to show that through cycles, we can provide that consistent level of income to our investors. I'm sorry, guys, give me 1 second. I mentioned earlier, you know, our default rates. You can see on the far left here, our long-term default rate is less than 1%. And also compared to the leveraged loan index, which is 2.11%, significantly lower. On the far right and in the middle of the page, you see 2 periods of punctuated volatility. I think it's pretty telling that our underwriting standards have come through, you know, with shining results in that during the great financial crisis, while there were elevated levels of defaults, we still significantly outperformed the benchmark. And during COVID, even represented a lower level of defaults compared to our long-term track record. So again, we feel that this helps to show that the 160 investment professionals that we employ at the firm and our process, and the fact that we stick to sectors that are a bit mitigated from volatility, help to provide you know, outsized returns by not going into deep holes that we need then to climb out of. It may result in having to take unnecessary risk to do so. So the consistency factor, again, I think really shines through on this page.
And just one thing to add, I think Peter's going through this really nicely, but if you look at the returns that Peter just went through, where you can see that going back to 2004, our net returns to investors are extremely consistent. We have over 80 quarters worth of return history for this kind of investment strategy. And in that 80 quarters, we've only had 2 quarters where we had a negative return, and those were usually driven by unrealized losses as opposed to actual loan losses that reversed in subsequent periods. The consistency of this strategy is really fueled by the slide that Peter just went through on slide 9, the below market defaults. We make money consistently for our investors by having a very effective business that's set up to not lose money. It sounds simple, but it's not, and we'll talk through what's particularly compelling about our platform that has us set up to continue to perform well for our investors, including in GBDC4. But I just wanted to point out that this page, there's a lot that goes into driving the consistent below market defaults and losses that we've had going back to 2004. But the result, this below market default track record, particularly during periods of elevated market volatility, is really what underpins why we've been able to generate the premium returns consistently that we have.
Thanks, John. ESG, I know, is a hot topic in some circles. I'd say just, you know, going through this, it's important to us. Don't want to spend too much time because I know we only have 30 minutes, but being a lender, ESG has always been part of our DNA. Lending to companies that are poor partners of the environment, their communities, or having poor governance styles simply will not result in long-term healthy relationships and providing capital back to our investors. What's been going, you know, through our firm and through the industry as a whole, I think has been a bit of a codifying of these processes, something that we can talk more about if you have questions. But again, just wanted to highlight that we are cognizant of how important this is in today's market. And again, something that is already been part of our process and something that we continue to refine. And then I thought this was an interesting page to highlight because I think it helps to show not only what we think is the opportunity in the US middle market space, but also I think it helps to reinforce and reemphasize why partnering with Golub is, we think, a sound choice. Because as you see, the middle market industry or middle market companies represent about a third of private sector GDP. There's over 200,000 businesses. It's a large part of the US economy. And it's being fueled a bit as well by the growth in the private equity space. And you can see that there's almost $2 trillion of dry powder in private equity capital. So in thinking, if I was in your shoes and thinking about who to partner with, a firm like ourselves that invests in our systems, invests in our human capital, again, the 160 professionals, almost 700 employees, we feel that we are best positioned to be able to comb through what we think is a large amount of deal flow that we generate through the over 300 different private equity firms that we partner with, and over 500 different sell side organizations, investment banks and advisory services that help provide us with deal flow. And that allows us to look for those lower and core names, and that we don't have to worry about being viewed as just a beta provider, just giving you access to the asset class. We only enact about 2 to 3% of the transactions that we see on an annual basis. And we're looking at about over 2,000 different transactions any one calendar year. So this helps us to provide what we think financing the companies that shine within their sector. And you can see in the bottom right how the Golub Capital Altman Index, which is looking at about 150 or so of our 600 different portfolio companies and looking at their median revenue growth, how it far exceeds the revenue growth in small cap, large cap, and US GDP. So again, we're looking for those opportunities that can move the needle, and we are constantly doing the hard work to make sure that we're lending to those sponsors that are bringing us the best firms to finance. So with that overview, on page 13 here, I'll turn over to John, and we'll walk you next through the Golub Capital Advantage, essentially our investment process, and then we'll move into the fund itself.
Great. Thanks, Peter. And despite what it says on Peter's video Zoom, I'm John Simmons, and that's Peter Kenny, and really appreciate everyone.
Sorry, Peter. I thought John was talking before. I was trying to pull
I'm
it
having a
out.
bit of an
Nice.
out-of-body experience seeing another version of myself.
He's the
but,
good-looking one.
I could only see the name on the side. I thought you were talking. All right, guys.
That's all right.
Go ahead.
It's all good. It's all good. Well, thank you, everyone, and really appreciate everyone making the time for us. I'm going to talk about two topics. The first topic is why is Golub Capital's business been successful, and why are we positioned well to continue to be successful for our investors? And then I'll talk about the fund, and then we'll wrap it up and take any questions. So first, on our business model and why has it been successful, and why are we positioned for continued success? We think of ourselves much like a bank in that we're trying to provide really valuable services to our borrowers and our clients, in this case, private equity sponsors. We want private equity sponsors to want to continue to work with us on all their transactions so that we become a really valuable partner to them. I'm going to start on the top left of this flywheel called Powerful Sponsor Finance Platform. I'll talk a bit more in a bit about why do we think we have a powerful lending business that is a solutions provider to private equity firms. But if you go for a walk with me for a minute, just understand that the private equity firms we work with, which are over 350 private equity firms in the US, they show us all of their transactions because they know that Golub Capital, which is a $60 billion asset manager, has the longest investment track record in doing what we do. We have the broadest set of capabilities in terms of lending solutions we can provide to private equity firms and their portfolio companies. So they want us to finance their deals. So they show us all of their transactions. By seeing a very large flow of deals, we're able to pick the ones that we think have the best risk-adjusted returns. So we're able to be very disciplined, and we actually reject 97% of the deals that we review. That allows us to be really selective, and it allows us in all of our loan portfolios to build very highly diversified and defensive portfolios, which have proven to be really effective for our investors, particularly in times like these with heightened levels of volatility and uncertainty. That disciplined credit selection and ability to say no most of the time has fueled what we went through on that earlier slide 9, the below market default rates. Those below market default rates in many of our funds, including in Golub Capital BDC4, we also borrow money from banks. And being able to generate really low default rates and very diversified portfolios allows us to borrow money from banks at the lowest costs and the best terms. So between the generation of a very defensive, attractive portfolio that doesn't generate much in the way of losses, but generates a high degree of recurring income, by being able to borrow from banks at the lowest costs and the best terms for us as a borrower, we're able to generate those consistent premium returns over cycles and over long periods of time for our investors. When we do that, as we have, and we showed you the track record slide, investors not only are happy with their investment with us, but they invest more with us over time. And their investing more with us over time grows our capital under management further and allows us to be an even more effective solutions provider to private equity firms so that we can do even more for them and they want to do more business with us. And now I've gone all the way around this wheel, and it becomes a self-reinforcing cycle that makes our business more effective for the stakeholders that we serve. So with that, let's talk a little bit more on the next slide about what we do for sponsors and why they like working with us. So I mentioned that we cover about 350 private equity sponsors. They are our source of deals. So private equity firm wants to buy a company, and we are providing the debt to support their purchase of the company. We work with these same private equity firms, and we have a track record that goes back to 2000 over and over again. So the top right-hand corner of the page shows that in a given year, over 90% of the deals that we do are with the same private equity firms over and over again. They know we're reliable. They know our financing solutions are effective and hard to replicate. And they know we can finance borrowers of all different shapes and sizes, provided we like the deal. And the result of that is that private equity firms are going to show us all their transactions and hope we like them. And the proof is really in this pudding, in the sense that private equity firms who work with us keep coming back to us to do more and more business with us. And you can see in the bottom right-hand corner of the page, and if you were to annualize year-to-date 2022, you'd see that our origination volume year in and year out keeps growing because of our effectiveness in what we do for private equity firms. We can lend across the capital structure. We have focused much more on first lien senior secured loans, but we have the ability to provide any type of financing solution that a middle market private equity firm might be looking for. We can finance companies that are on the smallest end of the middle market all the way up to the largest borrowers and financings that are over $1 billion in size. You can see that again on the next page, where you look at the average distribution of the annual earnings of our portfolio companies, and you can see that here, what we call the core middle market, the middle box, the middle bar, $25 to $75 million of annual profits. Over half of the deals we do are with companies that are in this core middle market. About 80%, if you combine the two columns, the middle and the left-hand column, are to borrowers that are in the core lower middle market. And we have the ability, given our platform size and the breadth of financing solutions that we can provide, to play across this spectrum, depending on wherever we see the best risk-adjusted returns. That is unique in our industry. It tends to be the case that a lender will focus more on one of these three subsegments. But by being as large of a solutions provider as we are, we're able to grow with our borrowers over time and be a really effective solutions provider to them and to the private equity firms. And if you go to the next page, you can see some illustrations of how we're a good solutions provider to our borrowers. So this slide shows that in addition to working with the same private equity firms over and over again, we're also working extensively with our existing portfolio companies. So in our portfolios, we have over 300 middle market companies where we're already the lead lender. We've already diligenced the management team. We've already closed a loan to the company, and we've seen how that company's performed in the period post-closing. 50 to 70% of the deal volume we do in a given year, and you can see that's been increasing, in the lower left-hand corner of the page, it's just lending more money to companies already in our portfolio. So these are really attractive risk-adjusted returns. We're not getting exposure to a new business and a new industry. In these situations, often where we're the sole lender or by far the largest lender, we are simply increasing our exposure in our funds to companies that have already been performing well for us. And on the right-hand side of the page, you can see an illustration, a few illustrations of the point that Peter was making earlier, where because of the breadth of our platform, we grow with our portfolio companies over time. And often these loans start as small loans, sub $50 million in size, and they can grow, and we grow with our companies, often where the loans exceed well over $1 billion in size. These are companies that are performing well, that we've developed a really strong relationship with. And once we're the lead lender to a company, it's very difficult to displace us. Private equity firms often sell companies to another private equity firm. And if Golub Capital is already a lead lender to that company before the sale, we often retain our lead lender role after the transaction and the sale to a new private equity firm. It's important to be the lead lender, and you can see some reasons why on the next page. Almost 90+% of the deals that we do, we are the lead lender. That means that we are originating the transaction directly from the private equity firm. Most of the lenders in our space are not directly originating the loans. They're buying them from lead arrangers like Golub Capital or other lenders. We're the first call if something goes wrong with a portfolio company. We have direct dialogue with the private equity firm about what's going well and where there are opportunities to fix some issues. In many of the loans that we provide, we often have a seat on the company's board. So we're at a very strategic level with these portfolio companies and the management teams, and that helps us identify problems early so that we can make sure that a problem, when we identify it, doesn't turn into a bigger problem and a potential loss. If you flip to the next page, you can see an illustration of the effectiveness of our sponsor finance platform in terms of our deal flow and then our selectivity. So the blue bars show that in a given year, we're sourcing over 2,000 investment opportunities year in and year out. And the track record going back about 10 years shows that consistency of our deal funnel. And at the same time, the gold boxes all the way at the bottom of the bars show that in a given year, we're only closing about 2 to 4% of the deal opportunities that we see. And so I think it says something about how reliable and strategic we are to our private equity firms, that they show us lots of deals. We say no 97% of the time. And yet 90% of the deals that we do are with the same private equity firms over and over again. So it's got to tell you something, the fact that these private equity firms know it's likely that we're going to pass on a transaction. But because when we say yes, we're able to provide them with financing that it is so effective and differentiated that they're willing to accept no 97% of the time, because those 3% of the times that we say yes, we can provide them with a service that they can't find anywhere else. And that's what leads to the repeat business that we've had. If you go to the next page, just
Hey, John, not to interrupt you, just
Sure.
because we're running up a little bit on time. So I don't want to rush you, but just to keep in mind that, I want to be respectful to the board members and their families and also to the other presenters too. So, obviously a couple more minutes, but I just as a heads up. So
Sure, no
sorry
problem.
to interrupt
Can
you.
we think we have time for 2 more minutes? It's probably all I
Yep.
think we need. Great. So if you flip to the next page in terms of our underwriting and our origination and how we compensate our team, I think the previous slide that showed that, well, we see a lot of deal flow and we only close a little bit of it. We're very selective. I think we're among the most selective lenders in our industry. I think if you talk to our peers or our sponsors, they would support that. But I think a lot of lenders can show you information that shows that they're selective. I think an area where we're distinct is in how we align the incentives of our people with the incentives of our investors. And there it comes down to compensation. We've seen financial institutions, particularly other lenders during the financial crisis and COVID, blow themselves up in part because they have compensation models that align originators to originate, even if the loans aren't good loans, and underwriters to close business. Underwriters are the ones that are structuring the loans and closing them, regardless if the deals are good deals. And that leads to outcomes that could be good in the short term for the investment professionals, and maybe even the investors, but often not good for the investors in the long run. And we looked at that model and said, that doesn't work. We need to be aligning our investment professionals to generate premium returns consistently for our investors. And if our investors do well, then our people should do well too. And so our incentive compensation of all of our investment professionals is heavily influenced by the degree of credit losses that we generate or lack of credit losses that we avoid in our funds. So when our funds are performing well, our people are compensated well. If we're generating losses in our funds, then that impacts the bonuses that are paid to our employees, even if the loan was made 4 or 5 years ago. And everyone who's involved in the investment process understands that. And it impacts behavior all the way to the point in time before a loan is even made. And that incentive that aligns how our people are rewarded with how our investors are performing has been really critical to generating consistent returns that are outperforming peers over time. Let's talk about the fund really briefly. So GBDC4, we talked a little bit about how we think it's a fund that's structured really nicely for investors. Peter, if we go to slide 25, effectively, actually, could we go to slide 24 real quick? The point I would make about this slide is the BDC, this is just a type of fund. The fund has been structured with a 50 basis point management fee, a 10% incentive fee that starts in year 3, but no incentive fee in the first 2 years. So you can see that on the 2 columns on the left in both charts that our fees in GBDC4 are among the lowest in the industry. And we think that we've done that in part because we think it's a very attractive time to be deploying capital in the market that we're in. And we want to make it easy for investors to say yes. We know that sometimes investors can be sensitive to fees. So we've reduced the fees dramatically in this fund. If you flip to the next page, what you'd see here in terms of GBDC4, it is a fund that's targeting 10.5 to 13.5% net returns. Based on the current market environment, I would expect us to exceed those returns, given that yields are quite high because base rates have increased and spreads have increased. The fund is going to be deploying capital while it's a private fund for several years. We would expect to fully call an investor's commitment within 18 to 24 months of the commitment itself. And it's going to spend about 6 to 7 years as a private company. And after the period as a private company, an investor has the choice of either getting their capital back in a cashed out return of capital, or if an investor wants to, the investor can continue to hold their shares through a public exit, where an investor would then own a liquid, publicly traded security that they could hold or sell at their choosing. But Jim, I know in prior lives, we've talked about the predecessor vehicles to GBDC4, this new cash out feature where an investor can simply invest during only GBDC4's private period is a new and novel feature that we added to make the fund more attractive to investors, regardless of whether they want to exit before a liquidity event or exit after a liquidity event. Peter, I don't know if you want to provide any closing remarks, but that was all I wanted to cover, other than just to say thank you to everyone.
If you guys could just touch base, sorry, Peter, just touch base on, the close, because I think we have some leeway here, but not too much, right? We have a few days if the board would want to do something. Is that correct?
The next close for
Yeah, I thought we had I was under the impression with Meg there was the September close, but we had I don't want to say anything on the record here, but
no. So
a couple of days. We had a couple of days flexibility till the 23rd if the board decided they wanted to do something.
That is
Okay.
correct. So the next close is October 1st, but in order to provide the appropriate amount of time for paperwork processing, et cetera, December 23rd would allow, if you were so inclined
Yeah.
to invest with us, we can make that work.
Sorry, Peter. Yeah, please wrap up, guys. Sorry.
I was just saying October 1st is the next close, and September 23rd would be the deadline that we provide an extension so that you all can, if you were inclined to invest with us, we can make that next close happen for you all.
And so what is the status of Fund 4 now? How much has been raised and what's the target?
We've raised almost $600 million of equity. And we don't have an exact target, but just given the terms of this fund, I would expect the equity raise to be $1.5 billion, probably, or potentially north of that.
And you feel that the opportunity right now is strong enough to support that additional capital raise, given your public fund and the other funds that are still outstanding?
Absolutely, yeah. I mean, if we had record originations in calendar year 2021, we originated almost $40 billion of new loan activity. Not all of that was retained by our funds, but if we had more capital, it could have been. So we think the opportunity set with how much capital has been raised by private equity firms, how entrenched we are with those private equity firms, and the continued shift from public markets to private markets, we think we're really well positioned to continue deploying capital. And in the last 3 or 4 months, with all of the market volatility, the terms on our loans have gotten even better for us and our investors. So we do think that targeting a larger fund size for this vehicle is appropriate. And we've been deploying capital at GBDC4 already. We've deployed almost 20% of the capital that we've raised.
And you expect to call capital probably over 12 to 18 months, or what's the expectation?
Yeah, I'd say 12 to 24 months. An investor should be fully invested. And there's no J curve. We already have a leverage facility in place. So the expectation would be right out of the gate, an investor could expect to be earning its target return at GBDC4 of call it 12% plus.
Yeah, that's you might want to explain that J curve term to everyone on the board here, because that's a major problem with some of these kinds of
Sure,
funds.
of course. No, thank you for the prompt. Effectively, what we mean is that because we're only charging fees on what's invested, and because the company borrows money from banks and other lenders, we are effectively, the fund itself is fully optimized from day one. We're not going through a period of time where there's startup costs that are going to, in the early period of a fund, result in below target returns for a period of time, only to reach target returns after several years of the fund's operation. We would expect that for the foreseeable future, as long as we're investing capital, but starting at the beginning of the fund, that the returns each quarter will be in line with the long-term target returns of the fund. And that's because we start day one with, we already have a portfolio of investments, and that portfolio of investments is funded by commitments from shareholders like yourselves, potentially, as well as borrowings from banks. And the combination of those two allow us to generate our target returns right from the beginning of the company's life.
That's very attractive. Thank you.
John Oliver, just one quick note.
Sure.
I checked my notes, and we can accept documents till 9/26. So that gives you till Monday.
Okay.
Weekend.
Thanks, guys. Well, appreciate the time. I don't know if anyone has any questions, but obviously appreciate the presentation and the opportunities that you guys are looking at and telling that to the board.
Thank you so much. We really appreciate it.
Thanks, Sean. Thanks, Peter. Appreciate it.
Have a good night, everyone. Thank you.
Right.
So, was we all
Thank you,
set?
everybody. I froze. I'm signing off. Thank you so much.
Okay, thank
Yeah.
you.
Sorry.
I think these guys are all off the phone.
Okay, you can see my beautiful bandage.
You
All
weren't on
right,
the
it's-
lab?
It's another
early.
gardening accident.
Jim,
Oh, man.
Jim, this is the second meeting where you've had an accident. What's going on? You all
Yeah,
right?
this was unfortunate collision between my eyeball and a branch.
Another tree accident?
Yes.
I thought it was Lindsay and I's fault with the
Stop working
markets.
on the yard.
You saw the August markets.
Does also very good job of sourcing, I think, appropriate opportunities for our fund, more in the credit space. John Oliver, I think, that's a good sort of investment for our fund where we don't have a lot of downside risk tolerance, but we need a good return target. And these kind of funds, I think, can achieve that.
Yeah, I
It's
think
a
when
nice
we liked it,
diversified
approached it, we don't need to do, obviously one of them we already have invested in, but how I've approached it or we've approached it at a firm is, we look at these investments kind of like a troika, right? We have Silver Point, which is, in a similar space, but they do it different than Golub does. And Golub's in a space where they're both kind of high in the capital structure, which we like. We didn't get into it too much about how they handle bankruptcies, whether it's, Chapter 11 versus Chapter 7. Most bankruptcies are Chapter 11 that, if they have to deal with them. But, effectively what we like about Silver Point and Golub, lower risk, high income, high yield. And, from our study and our investment committee, when we looked at the 60s, 70s, not that this is like that, but, whether we're in an inflationary or deflationary environment, we have in the portfolio what I consider kind of a lack of income or cash flow into the portfolio. When I look at the equities, broadly speaking, this is a little less than that, but we're getting maybe 2% from dividends. The S&P is giving us 1.5. The value is giving us a little under 2. Actually, the biggest yielding in equity in the portfolio, surprisingly, I think, is emerging markets, which are a little over 3%. So when I think about cash flows, the vehicles we have are, kind of investment grade bonds, the PIMCO fund, and then also the Boyd funds. But when we think about the other things, they're much more geared towards capital appreciation or settlements, like in the Longford fund and in the equity. So, as we look at a tough environment here, I think, as I have spoken to clients and you all, we have one group, Grey Wolf, Jim, you might have missed them in the beginning, that has a little different type of structure, but how we're positioning them is kind of 2/3 in something that we look at as more, I don't know if it's more secure in that Grey Wolf's kind of looking at very distressed or opportunistic things. So, a lot of the risk has been taken out of their stuff. But when I think about, the consistency of cash flows and getting 2/3 that and then mirroring it with the opportunity for a manager to go in and generate some upside, which we've seen, I think for us, it's something I wanted to present as kind of a troika. I presented it to clients because, we position this all in the fixed income or credit portfolios. I mean, we could talk about it as alternative stuff, but generally we position this in the fixed income and credit portfolio. But, that's probably a discussion that we could have, whether it would go in, the quote inflation or alternatives bucket as opposed to the fixed income credit bucket. But, for us, we kind of look at this more as when I think about inflation and differentiated return streams, these are giving us, in my opinion, correlation to credit and, to some degree equity markets, because you're getting into, credit sensitivity within these companies. So for us, we've been positioning it more as their credit vehicles and in the fixed income / credit. So that's kind of our recommendation when we're allocating it, but that doesn't mean we have to do it there. But in terms of, as we're thinking about these markets going forward from risk, we really want to have a great identifier in terms of, what are our equity risk, what are our credit risk, and then, what are these other risks outside of things that are directly correlated to those two kind of marketplaces. So, when I look at these vehicles, even though they're senior, I mean, they're bonds. I mean, they're fixed income vehicles, or they're contracts that are kind of credit like vehicles. And then certainly in the Gray Wolf, they're going to have, obviously credit and bonds in there. So, that's kind of when we think about it as, an allocation in any fund. But I'm happy to kind of open up that discussion. I know we're getting long on time a little bit.
Sorry, Gray Wolf being a distress strategy, sorry, I missed that presentation, but that would be much more of an equity oriented strategy, wouldn't it? Where they wind up with an equity stake in the firm that they have through
so
debt.
at times they've actually in, and this is kind of why they have it as opportunistic. We invested with other clients in what they called their distress fund during COVID, which, ended up not being distress. It was kind of, a different, it was a special situation. Maybe we could call it because of COVID or some degree like that. So I think the way they have the fund prepared is, if it is distressed, they'll go into that market, or if it doesn't end up being distressed, I think their point was, the example of what they did kind of during COVID, and it'd be more of like an opportunistic or situational investment. But and some of it they're taking the equity position, but in some of it they're just unwinding the positions after the stress. So like, Cirque du Soleil, they unwound that a bit in the fund. So, they're doing both. I mean, ideally, hopefully they're buying things that don't need to go through restructuring, and they're buying, these bonds on 10 cents on the dollar, and they're going back to 30 or 40, 50 cents, ideally.
So would we, assuming we were to select one of these investments, it would come from the bond some of the legacy, like the Western Asset, would be where we'd allocate, we would pull funds from, because I think we'd have to exit one of our existing investments, I would imagine.
Well, we're kind of at the bottom end of the range on the fixed income portfolio. After this little sell-off here, we're at about slightly under 20%, which is the bottom range is 20%. We could take the fixed income up to, significantly more than that. So, I wouldn't think we need to take away per se from the bonds yet, because, most of these things are obviously they, Eve, I think, mentioned this on the call. If we get into some crazy situation where there's a huge market dislocation, they're going to call capital quicker. I would say in that situation, it'd come, probably out of some cash, some bonds, and then maybe some a bit of the equities. I think in the longer term scenario, we'll have some discernment as to where we're able to peel it from, whether it's somewhat on the equity side, or somewhat on the fixed income side. But, we're pretty low on fixed income. So, it's hard to take a lot from there. And then kind of beyond that too, as we look and say, here, we have a pretty big position, which is okay. We want to be the US over the rest of the world. But, when we look at some of the maybe potentially emerging international, we would, in a bad environment, we'd probably, even though we're pretty focused on US, we could probably take a little bit from that as well. So, if we did it today, like today they called it, I would say the first step is we're going to go emerging to international. And then, we'll see, depending on what US markets look like. Clearly, I think I've said this before, like the US markets are the, dirtiest clean shirt in the basket, so to speak. We were looking at this. I mean, the European and markets look really rough, and I think emerging markets look the valuations look great. tough sludge going forward, I think, for a lot of them. And then Russia, which isn't in the index. Not that we want to be in Russia. If it was in the index, that'd probably be up 400% because most of the companies there are oil and gas, but now it's not in the index. So, not that this is a comment on Russia, but after the investors in the index got, even though it was small, got crushed in that weighting in Russia, you don't usually get to make that back when you have whatever it was, 5%, or off the top of my head, roughly 3 to 5% go to zero in an index. It's hard to make that up. So
what's your recommendation for what we should do? These would go into the alts bucket, I assume. And what do you?
I mean, I was just saying, Jim, I would think about these more as credit or fixed income as opposed to the alts side.
Well, I mean, we have Boyd and alts. I mean, the thing about these is they're all illiquid. So I think they do belong in the alts bucket, but it's not like private equity. It's more of a credit strategy within that bucket. But what's the max now we've given you for alts? I think it's up to at least 10%. I'm forgetting what the ceiling is.
I think we raised it to 15.
15.
Yeah, 20%.
20. So you've got room in alts for this sort of stuff. But
and I
you have
think
to
too,
take it out of somewhere else.
Yeah, that's fine. We could do it there. I'm happy to put it either place. And also, just in terms of that portfolio, that's about a little under 15% of the portfolio. But just in terms of thinking about, this is going to get raised ideally probably over 2 years for most of the funds. And then, we can see what the market looks like at this point. I mean, obviously we like the GSA fund and some of these real estate funds, but, clearly there may be a point where the opportunity cost of owning that versus, let's say, I don't know, treasuries, for example, right? You're getting into maybe some trade-offs at certain times. So, we may not always have this robust of a position in these cash flow things from real estate, although we like them a lot now. So it's just a thing to think of.
Well, let's say we took inflation protection alts up to the max of 20. That would be roughly another $4 million, I guess, to be added, correct? And we're putting in 2 million, but this is, like you say, it's not called all.
A little less than that. It'd be like, what would that be? It'd be like, what, 3 million, maybe something like that. A little less than that.
But we do have a 2 million commitment to the Boyd Watterson new fund.
Yeah, I have that in there. It's already in there when I'm looking. So we're at 14.68 right now. And also that's come up a little bit because both the equities and fixed income have sold off. So you're getting a little bit of an increase. I mean, that may continue to be the case, but that's in there. So right now, Jim, it's about 14.6 in the alts and inflation. So.
All right. So there's not that much room left, I guess.
Yeah, there's probably, if we did $1 million in each, that would probably be fine. And then if we needed to raise, I mean, the Boyd funds are pretty, this is all relative to the market environment, but the Boyd, especially the GSA and the state, I mean, they have pretty long queues. So getting liquidity, if we needed to raise something out of there, if we got to, past our skis on the allocation or have our skis, that'd be pretty easy to do. In terms of
I
think
you could probably do at least another 2 million in commitments to the two that seem the safest to me, but again, I didn't listen to the whole presentation for Grey Wolf, but Silver Point and Golub to me would be appropriate, since I'm already familiar with those guys. Sorry, go ahead.
No, I was just going to say, Grey Wolf was pretty interesting. It seems like that's more, I mean, in my experience, it's more of like the special situations, stock picker kind of manager alpha, if you will.
Yeah.
Boyd Watterson, I think the new fund, the REIT, I mean, if we want to throw money there, that's kind of a no-brainer.
which we already have, so.
which we already have, exactly, but it's in a different vehicle. And, you know, we've done the GSA, and then
We've also committed 2 million to the
state
REAP
one.
fund, the REAP fund,
exactly.
the brand new, the third fund.
Okay, my mistake.
Eric, before you were on the board voted, and we had a presentation by them, but I just wanted them to come back in because they had just called the money to give us
Okay.
an update. So I think just before you got on the board, Eric, we invested in the REIT, and it's been kind of in a queue as they're building up. Yeah, so we actually have about 2 million 2 million in the fund.
So
with the REIT
okay,
activity fund.
that basically is, you know, off the table. But also impressive was Golub and the other one, the silver. So
I mean,
it runs the,
Silver Point, I think, is one of the. I don't know if they're the, you know, I don't like to say terms, you know, they're a great investor in the space, and you know, Golub's been too. I mean, it's hard to.
Yeah, I actually was an investor in the credit fund, especially credit fund 2, and Mike Gatto, the manager there, he focuses in on, you know, I don't know, with the gigantic growth of their assets, it might be a little tougher to do these things, but he finds very idiosyncratic lending situations just ridiculously good, or it'll be like a solid piece of real estate and it's a 50% loan to value and he's getting like 12% with all kinds of upside kickers and things. So that one is quite different than Golub, that's doing much more straight down the middle private lending to you know, basically private equity managers, sponsors of these private companies, but it's super diversified and very well-oiled machine that's been performing through the cycle with admirable results. So I think that one is pretty safe. You can also invest in their public fund, but that's going to be more volatile because it's subject to the whims of market volatility, whereas the private funds don't really get marked to market that much because they don't have credit events that cause them to mark things to market. So it's a very safe place.
But we give up liquidity.
Correct. Yes.
Yeah.
But you also,
but you're still getting, you know, you're still getting some distribution. You know, these are, I don't want to call them illiquid. They are to some degree, but they're, you know, semi-liquid in that we're getting distributions.
They're income generating.
Income generating. I mean, our recommendation would be to do, you know, depending on size, we feel obviously if we're doing it in the alternatives, our thing would be to keep it as kind of like a stool and do $1 million in each. And that way we're taking advantage of the income. And then also, you know, we still have some opportunistic investment in there too, that can give us, you know, a manager that's, you know, kind of navigated some pretty bad markets and done, you know, we've invested with them for a while, so we feel pretty comfortable with them. But, you know, that's kind of our recommendation, but I'm happy to go at the direction of the board. We would just, to keep it simple, we do $1 million each, and then you have two managers that I think, you know, famous last words, are very safe, or very safe within the capital structure protection around our capital that we're putting in, even in really a bad scenario. It's, you know, I would say it'd be, you'd have to have maybe 3 years in a row or something like 2008 to really, you know, feel it negatively in the portfolio for these guys. Even if you look at 2008 and how they navigated that vintage fund was pretty good. So, you know, for us, knowing the managers, I mean, we would recommend $1 million in each. That wouldn't put us in, then it's be over 2 years. And, you know, it would also give, you know, as Golub and Silver Point are building the portfolio, you know, there probably going to be some credits they would never even look at that I think Grey Wolf would take advantage of. I actually, you know, can't say here, but I know a couple of them that they're looking at. So,
okay. So you're talking about $1 million each in Golub, Silver Point, and Grey Wolf, and we'll keep Boyd Watterson where it is. Is that what you're saying?
Yeah, and then, you know, like I would think that, you know, Jim could certainly speak to the fixed income program, but, you know, you're starting to get points here, and depends on, you know, what type of environment we enter in and Fed policy. But, you know, you're starting to get to a point here where you're looking at, I mean, I was looking today, it's kind of baffling, but, you know, you're getting a 1-year treasury at 4%, or I don't know, 4.038
6 months
or something
is
like
385. 6 months bill 385. Not too bad.
some people argue that the long end of the curve looks the most attractive, but that's after 20 and 30-year bonds went down over the last 2 years 38%. So yeah, of course it looks attractive, but yeah.
Well, the other thing about at least the Golub and the Silver Point investments is that they're pretty much all floating rate. So you don't have that
Yeah, I know. Yeah.
duration exposure. You do have credit exposure, obviously, though.
Yeah. Yeah. And what I mean, we kind of too, we have the PIMCO. I mean, it's a mutual fund, so it's in but like the PIMCO fund is kind of unique too, that we have in the portfolio, and that it has long position, short, it's going up and down the capital structure. I mean, it's dealing with different types of credits, and that they're all, publicly traded, and you're talking Silver Point Golub using private credit, but still we kind of have some different things. And so even if we down the line, we could always look, and depending on what's appropriate, we look at what these portfolios are and even put them in a private credit or semi-liquid or hedged credit portfolio. We've broken out some clients fixed income credit into multi-credit and also private. Obviously it's hard a little bit in this fund to go purely into private debt as we look at funding and liquidity issues. So, when we do want to, we want to match some cash flow with the illiquid stuff. So apologies, I'm going a little long here, guys.
We're getting into the nitty gritty.
The Gray Wolf strategy, though, that's not going to be as income oriented as the other two, correct?
No. That's why when I said it's, we're doing it like three legs of a stool or troika, whatever.
It is entering a period where you would expect good opportunities in that space.
Yeah, well, that's kind of why. And some of the, we did the other fund during COVID, and unfortunately, we didn't do any of the co-invest. Actually, we had some clients vote on doing them, but like, I don't know if you saw them. So some of them we which I like about Gray Wolf, we had about 50 million committed in co-investment stuff, and they didn't do it. So I like that as a manager, that discipline, because they easily could have taken 50 million in capital from our clients and invested it in things that, like they said, went up on day one 105%. I think a lot of managers would have taken the money and invested in it, and they didn't. So that's always I think that's a positive, I guess, about a firm that isn't just trying to gobble up as much capital as they can at the expense of returns.
Well, so what you really need is for us to vote on a resolution to commit capital of these three funds, correct?
Yes.
So I'll leave that up to our chairman to decide whether we should go ahead with such a proposal.
Before we vote, do any other board members have any questions or concerns about before we proceed? Any reservations that Anthony and Jim not being on the call?
Yeah, I did miss the Gray Wolf portion. The only concern I think that people should be aware of is these are illiquid investments. So we have to realize it's going to be a 5 to 10 year time frame before we have access to the capital. We'll be calling capital over 2 to 3 years, perhaps. And then we'll slowly get capital back. So we have to be comfortable with that. That's why we have a pretty tight limit on the alts bucket. But the fact that most of these things are income generating does reduce that impact.
Right.
Getting money back every quarter.
And also too, we should be getting some, we're getting it. We actually got a distribution. I didn't talk about tonight. I'll save everyone the time, but the Longford 2 fund, we should be getting, winding down. They had a pretty big settlement. So we're getting a wind down. So that'll be another, 2+% of the portfolio we're getting back. But, hopefully it's more than 2% when they get some of the returns back. So we're getting some distributions from that. So I would expect the fund 2 within the next, we're getting some pretty big distributions back. So I would say by the time these funds are funded, we probably won't have much left in the Longford Capital Fund 2, just as a point to note.
Yeah, and then, as you said, Boyd Watterson is a 5% position, but it's an open-ended fund and there's a long queue. So that's basically a liquid
Yeah,
position.
the state fund too.
Yeah.
For both.
I mean, do we foresee a situation where we're gonna need to make major distributions from the pension fund to retirees that are in excess of our cash position in the next couple of years or 5 years, say?
Yeah, that's something that Anthony could better address, but
Okay.
I think he's been on
Yeah,
board with this allocation strategy. Go ahead.
I don't see an issue with that because we also make contributions every quarter.
Right.
And right now, I think we only made one payment. So I'm just looking it up.
And we've been running kind of flat, as I recall, between
Yeah,
contributions and payouts.
yeah,
But it will go into deficit over time.
Right, if we're getting back capital on funds that are liquidating, over the next couple of years, getting distributions back, then that should cover that.
Well, we're also 80% liquid, so
Okay,
even if you're
yeah, then
20% illiquid.
that really takes care of any reservation that I have. I think these are really interesting managers. And I think committing $1 million to Golub, Silver Point, and Gray Wolf is, I think it would help diversify the portfolio and provide us with some opportunities. It's an interesting time. Yeah, they struck me as good managers, so.
Yeah, we've had a great experience with them. That doesn't mean that, but we're not going to bring someone we had a bad experience with. Let's start with that.
Thank you.
If we're hiring a guy to back cleanup, we're not going to bring the guy who's batting 95, his batting average. So, we've had a long history with these managers. We know them intimately well. Although I'm sure John's gonna make fun of me that I was calling John Peter, but whatever. I couldn't see him, so I'm sure that I'll get a hard time about that. We know them very well. We've invested, yeah, so we're investing for a long time with them, and we've had a lot of success and a high degree of comfort with them.
Yeah.
For a lot of
think
reasons.
I think the performance of these alt funds that we've invested in over the years have, it's particularly this year is really shining. So I think continuing to build out the pensions exposure to this segment, I think, is important. From logistically, from a paperwork point of view, with Golub, is that going to be an issue? Donna, is there any issue on our end, or
that, I'm not
Maria?
sure.
I'm sorry, Maria.
That's okay. I'm not sure when the paperwork will be coming in. I'm sure in a few days, probably, John Oliver, right? And then
Maria, Lindsay and I will work to get it to you tomorrow.
Yeah,
Pretty
I'm here.
easy.
I'm
Because
here.
we kind of have it. So you just tell us how I can get it to you tomorrow. Then, we have a little more time with the Silver Point, but I'll just get all of them to you, and then we can get them all done at once. Well,
And-
sorry, guys. You guys need to go through your vote and stuff. Sorry, I apologize before.
And as far as the liquidity that you guys were worried about, that these investments will be in for the long term, like 3 to 5 years. Like you said, you have Longford that is there's a payout, right?
Yeah, we actually had we had a net distribution from Longford 2. I don't have it in front of me. And then Longford 3, we actually had a major settlement in one of the cases, which represented about 4% of our entire capital commitment. So, that's a huge settlement. And then we also had a capital call, so they netted it out. So we actually didn't have to send any capital to them. So, that was a major thing. But Fund 2 is kind of,
And the
moving along.
GSA is very liquid.
Yeah.
But if we need to get funding out, we could get funding from GSA.
Yeah,
Right.
and then as Jim said, we have 80% or so of the portfolio. I mean, I don't want to overstate it, but we could get that liquid in a day.
Right.
60. Yeah, we could
and
put in
also
all the
we're
equity
making-
trades in a day if we needed to. If there was some emergency, crazy.
Yeah, and we're
environment.
making $5 million in contributions for the year. We haven't made any right now. So this fiscal year, we have 5.3 million to contribute to the
Yeah.
fund.
Yeah, I think it sounds like we have plenty of capacity to add some more illiquidity, particularly
Okay.
the kind that are cash flow generating.
Yeah.
All right. So.
Just
we-
Jim, with communicating to Anthony, I think when we had decided to move forward with the Boyd Watterson, the newest Boyd Watterson fund, if I remember correctly, I think Anthony did have some reluctance about committing money to that fund. I just want to be respectful of all the board members. Again, I have no reservations about voting this evening. I just want to make sure that if we can just bring him up to speed, I think he'd appreciate it, and I think it would just be a good reach out. Because I think these are, again, unique investments, and I wish he was on the call tonight. But again, that's just my kind of reluctant, and I don't call it reluctance, but just want to make sure that he's brought up to speed, with these new proposals.
Well,
Yeah, one possibility, since there's a little bit more of a deadline for the Golub fund, we could just vote on that tonight, and that's probably the most conservative of all three of these strategies.
Yeah, Gray Wolf too has a little time, by kind of month end too, but
And then we'll be having our next board meeting
Next month.
so we could decide on the other two at that time.
Gray Wolf has a close too. I don't know if they said it, but they have a similar close to Golub as well.
Who does that? Who has that closing?
Gray Wolf and Golub. Well, we could talk next month, or an interim meeting about Silver Point if we needed to, but the other two we probably need today or tomorrow, I guess. And then
So Golub, Gray Wolf needs a decision tonight, basically.
yeah. I mean, just on a logistics side, if we decided to do it, it'd be better. Obviously, I don't want to have someone on the board, feel discomfort about it, but logistically, and then paperwork, populating it, making sure Maria gets that in an appropriate time, so she wasn't, running around last minute. The last thing Lindsay and I would want is that for Maria. So I mean, we would work to get it all. We'd spend half a day tomorrow to get all the paperwork populated for you guys and get it right over. I mean, we probably either have someone drop it off directly or whatever. So that logistically, I mean, if there was another call someone wanted to get on and vote between now and, I guess, what did Golub said, the 26th, but we're still getting, we're at the 20th here, so maybe tough to get a quorum between now and then for both funds. Sorry.
and
But it's up
just
to
a
you guys.
Patrick, do you
Um,
think Anthony only has a concern with Boyd Watterson?
I just remember he had concerns about the fund, and these are unique strategies, and I don't know if it was just unique to Boyd, or he wouldn't have any reservations about these. I just want to make sure that given his role within the town, that his opinion is respected.
Mm,
That's my one concern. I just feel that. But if we're pressed with, if we're really pressed with, we have to make a decision on Golub, and we have to make a decision this evening on Gray Wolf, then I think we make the decision. And if we're going to make the decision on those two, then why not just do Silver Point? Silver Point to me seems like the most conservative of the three funds that were. I just want to make sure that his opinion is respected and his role in the town is respected. That's my only issue.
Yeah.
I have that as far as reservations going forward with these three investments, I do not have any reservations. I think we should go ahead with them.
Well, I think what we have here is at least 4 board members who agree with you. So, I mean, I appreciate your concern for Anthony and keeping him in the loop. I'm happy to reach out to him tomorrow and talk to him about this.
Even if we made a decision today, and if it's not, the deadline for the paperwork's not Monday for the other 2 funds, we could bring it up next month and we could reverse the vote. for the items that for the ones that he's concerned with.
Although
Although
if we commit capital, I'm not sure we can do that.
once we submit paperwork, we're probably
Right,
committed.
right, I understand, but the ones that we need paperwork is only the Gulliver and Silver, is it?
No, it's Golub, is the most immediate. Gray Wolf.
Gray Wolf and Golub, both.
What was the date for Gray Wolf?
They're gonna do their first call, which would be 5% of the fund. So for us, 50,000, it would be if we did $1 million, the 29th.
Oh, okay, so that's right away too.
So I have all these, all these people have kind of an extension for us if we want any investors to go in, but.
Well, I would say, I will make a motion that we commit or allow our manager to commit up to 1 million each for these 3 funds. But we'll give Anthony, a day or two to object, in which case we put the whole thing on hold, I guess. So it would be a little bit of a contingent vote, subject to Anthony, who is also our town treasurer.
Yeah.
Subject to his approval as well. But that way we would have had our, full board vote on it, and Anthony would have had his say as well. Does that
Well,
sound
Jim-
acceptable?
Jim Daly is not here too.
Correct.
So Eric, you're gonna be calling Anthony?
I'll call Anthony tomorrow and I'll bring him through the discussion that we had tonight, and I will give him my opinion.
Right. And then maybe you can send a, yes or no.
I'll send out an email. I'll
Yeah,
send
and you
an
can
Can we do a
email.
vote by email?
We could do that. I think, I'm not sure.
we could just
whether
vote-
Robert's rule says we can vote by email, but Jim,
Why don't we just vote,
I would second your motion.
Yeah, why don't we go ahead and vote tonight, subject to Jim Daly and Anthony also, because I'm assuming it'll be unanimous. So
Yeah, I mean,
well, subject to Jim Daly and Anthony having veto.
yeah, we have majority right now. We're just being courtesy. We given the courtesy to the other 2 board members, basically.
Exactly.
So,
So I'll make my motion that we approve up to 1 million to be committed to these 3 funds tonight, subject to objection from either the 2 missing board members, Jim Daly and Anthony Musto.
I
Is there a
second.
second?
I
I
will
second.
second that.
Okay,
Whoever
Maria?
went first.
how about Maria?
It's fine.
Yes,
Okay, all in favor?
aye.
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 Opposed? And abstain, not that we haven't abstained, so the motion passes. And so who will follow up with just the email?
I will.
Okay, thank you,
Okay.
Eric.
Yep.
Thank you.
So you'll
Again,
do
maybe
both
it's-
of them, Eric? Jim?
Yeah, I'm going to email everybody. I'm going to email the whole group,
Okay.
give you a little bit of a summary of our meeting tonight and how we tentatively voted, subject to their right of first refusal, I guess.
And I guess we don't get copies of those presentations that we can send to these
Yeah, I was.
missing
yeah, I
board
was gonna
members.
say.
do
We don't, but this meeting is being recorded. So if they want to see the presentations, they will be able to see them.
That's true. You're right.
Bill, you could provide that information to the board members if needed? Okay,
Yeah, if it should be up there on the town website, but maybe you could send that to everybody. So, because I would like to actually listen to the Gray Wolf one myself. Great.
Eric, if you need, sorry, through the chair, Eric, if you need help with any of the email stuff, just feel free to reach out to me tomorrow or
probably will.
whatever the proper procedure is, just so, and then if you guys are okay, we'll work on our end, we'll get all the papers done. We'll get it to you, Maria.
yes.
If you sign it, we'll just hold it until, and if it doesn't go through, that's fine. We'll shred the paperwork.
When's the next deadline if we miss this one, John Oliver? Quarterly?
I don't know.
month,
Yeah, I
yearly?
mean.
I'll find out tomorrow. I'll ask him in the
Gray
morning.
Wolf's
I'll let you know.
probably closed out. You know, it's hard to say. I mean, I think
Okay.
Silver Point will probably have all the, you know, some of these funds are, I don't want to say they're in such high demand, but like they have repeat investors who've done well. So usually they're filling up pretty much the capacity of the fund pretty quickly at the deadline. So it's, you know, not as often that some of these guys who are sought after have these multiple closes, but you
Okay.
know, it'll kind of depend on how much capital they get in usually.
And
Well-
what is our next board meeting? I'm looking for it.
Phyllis,
I'm sorry. What did you need?
Next board
when's the
meeting.
next board meeting?
Phyllis? I'm sorry.
I have October 25th on my schedule. I don't know if that's the same that everyone else has.
Yes, I have
Thank you,
that.
Bill, that's correct.
Yeah.
Bill, it's the
25th.
last Tuesday of October.
October 25th, is that what you?
Yes, yeah.
The last Tuesday of October.
Are there any other questions?
I just want to say thanks, everyone. I know it's a long night and I really appreciate all the hard work you put in because these aren't easy decisions, but as you all know, these are important funds that, you know, need to be around for, you know, important people in the town. So I really appreciate you all letting us present these opportunities, whether we do them or not. You know, thank you all because your time is important and, you know, you all don't get enough thanks for the work you put in. So I appreciate it on, you know, our end.
Yeah, and
Thank you,
thanks for
John. Thank you,
sourcing these.
Lindsay, for all your
Yeah.
assistance in pulling that together. That was great.
Yes, thank you.
Thanks.
Very informative. And so if we, I think that's it. Did someone propose a motion to close our meeting for
I
this
will
evening?
propose that motion. I move that we adjourn. Thank
Okay.
you, everyone.
I'll
Is there a
second.
second?
Thanks, everyone.
Thanks,
I'll find
Donna.
a second.
Everyone wants out?
Everyone's
Uh,
out.
Okay.
So I think
Good night,
let's vote.
everyone.
Good night,
All in
everybody.
favor?
Good
All
night.
in favor?
Night.
Thanks, everyone.
We're all in
Right.
favor.
All right. Good night.
Night.
By
Thanks
leaving.
very much.
Bye.
Bye-bye.